talking about at the beginning of 2020, but here we are.
They've been hugely debated over the years and rarely used, particularly at that kind of 15-minute halt. But in today's day and age, I mean, I get it a long time ago where it was yelling and screaming on the floor and all the romance of the exchange. Today it seems almost quaint.
Well, actually,
I don't know what else to say.
Worse than quaint. Some people are saying that it's actually exacerbated some of the price moves overnight in other markets because you have the U.S. market halted, and the implication to other markets is that things are so terrible that things had to be frozen, and that's sort of one concern people have.
Yeah, I'd let it go. My basic point with it is it's quaint and it will be tested. It'll be interesting to see what we see this morning. But the point is, we will get when open the VIX. I haven't even correlated where the VIX is. There are some good notes on that over the weekend. But within the data check, I'm looking at Euro Swissy 105.844. George Saravelis with that incredibly important note for Deutsche Bank. And you wonder here in that, where are the surprises going to be given these market moves? John, what's the surprise you see?
We'll turn back to John Wraith in a minute. The surprise for me was just seeing the move in oil. Not that we didn't expect to move lower, of course we did, but to see crude gap lower by 31% is stunning. And many of us, of course, got up early for the European Open this morning. And just to see this series of red headlines just crater through the Bloomberg, the DAX falling as much as 7.4%, set to enter bear market. The Stoxx 50 down 4.7%, set to enter a bear market. The Stoxx 600, the FTSE. These headlines just kept coming through the terminal at this brutal speed. And when you see things lighting up that way, I think, Lisa, it just adds to the panic of the moment, doesn't it?
Absolutely. Also, the question is, where are the stress points? Again, I go back to, what's going on in the currency markets in particular. The Japanese yen very much in focus, with the dollar plunging 3% versus the yen, raising questions about whether this is margin trades being unwound, whether this is sort of leveraged currency bets, and sort of when does the Japanese government step in, given the fact that their economy is not doing well and wasn't doing well ahead of the coronavirus.
Away from the major pairs, folks, and this is inside baseball, but you look at dollar yen, you look at euro yen, how about something like yen Singapore dollar? It's 8 standard deviations off trend. All you need to know is that's worse than a medical chart, to be honest. I mean, 8 standard deviations is a huge move. John, I look at these distortions in the market, and I'm sorry, central bankers have to react.
I'll give you a worse currency pair than that. Norwegian krona versus the Japanese yen at one point overnight, a 6 percentage point move on a currency pair. Unreal. Let's turn back to John Wraith, shall we, and talk about the next central bank move. UBS head of UK rate strategy still with us. John, on Thursday, there's an ECB meeting. I imagine President Lagarde wanted a little bit more time to get her feet under the desk and get used to her surroundings. How difficult is it for her right now to get that governing council on side to deploy something this Thursday?
Yeah, I mean, unbelievably difficult because unlike the others, although everyone's rapidly heading that way, they have, to a large degree, and has been the case for a while, run out of ammunition. I mean, the market's expecting, I think, another sort of 25 basis points of ECB easing over the sort of, course of the rest of this year. But, given where they're starting from, it's really questionable whether that's going to have any impact on anything. They can obviously resume, step up, intensify government bond purchases, but they need to change issuer limits to be able to do that in any significant way.
John, this is so important. Mark, they're being overcome by events, and the event is disinflation and outright deflation. I mean, how do central banks act to the impulse of disinflation that we're living right now this morning?
If they'd had ammunition, then clearly they would be under pressure to deploy it in a very significant way, which is why we're pricing in what we are for the Fed, for example, and to a degree the Bank of England in terms of rate cuts and QE and so on. But as I say, the ECB is already there, so the sort of pressure on fiscal policy is going to be even more significant and come even earlier there. Then you have the problems, of course, in the Eurozone of the fiscal compacts and the either unwillingness or inability of governments to borrow within those rules. So, the problems there are even more intense at a time when monetary policy has its foot to the floor, and yet we're now being assailed by, this perfect storm of events all pushing in the same direction in a very severe and almost unprecedented way. I mean, it really is, emergency stations for all of these central banks and governments. And in the case of the Eurozone, the monetary policymakers have pretty much run out of road, and the fiscal policymakers are constrained by these rules. So it's probably an even more severe situation and even more worrying one there than elsewhere, I would argue.
John, we saw this morning 2-year and 5-year UK rates fall below zero for the first time. And I'm wondering, what is the prospect of negative rates over in the United Kingdom, as well as potentially even the United States?
Yeah, I mean, we had gilt yields, they're back at sort of zero or slightly above now, but we did have, as you say, shorter-term gilt yields drop below zero. They can certainly go lower still. You know, there is this mantra now that it's about the return of capital, not the return on capital, and short-dated sovereign bonds of well-rated issuers are the safest assets out there. So people will keep buying them even at negative yields in this sort of environment. When you look at the swaps market, rates are still some way above zero in the UK and the US, and likely to stay there as long as both the central banks say, you know, we can cut, we will cut towards zero, but going negative brings counterproductive consequences by squeezing banks' margins excessively. The financial markets so far have believed that line, and therefore swap rates, I think, have a very hard floor somewhere around 25 basis points or so, which we're sort of rapidly heading towards. But I don't think they can go negative unless negative policy rates becomes more realistic. I think we're still some way from that in markets like the UK and the US.
Hey, John, great to catch up with you. Appreciate your time on such a busy morning this morning. John Rafe there of UBS. A headline just crossing the Bloomberg from the French Finance Minister, Bruno Le Maire. Europe must work on a coordinated, strong response. And this has always been the criticism of Europe. They finally start to act when they face a crisis, but they never get ahead of it. And that'll be the criticism of the Europeans once again. This is something they should have done ages ago, should have been talking about ages ago. This economy has been stagnating for years.
I do want to bring you another headline just crossing that the Federal Reserve is increasing the size of overnight and term repo operations. And this just sort of goes to the point, Tom, that you were talking about earlier, the idea that the Fed needs to jump in and try to ease some of the stressors. The focus really now is on the systemic integrity of the financial system as it manages through some of these extreme moves.
And we're looking at German yields catching up, of course. We didn't get to negative 1% in the 2-year yield, but that's extraordinary as well. Each hydrocarbon analyst has their own skill sets. Amrita Sen of Energy Aspects is absolutely outstanding at the microeconomics, the movement of equilibrium around supply and demand within hydrocarbons. She joins us now. Amrita, thank you so much for taking time with us this morning. How does Russia fight this war? How does Russia defend itself in attack in the oil price war with Saudi Arabia?
I think Russia can sustain lower oil prices for a lot longer. I'd say it's up $30 for 6 to 10 years, of course, by drawing down the sovereign wealth fund or a big chunk of it. But I think the big challenge now is for Russia is going to be Putin's been focused on expanding a lot of the infrastructure projects, kind of in his bid to stay in power for a very long time. So that break-even, so Russia's break-even is around 40 to 40. But if you include all this new spending, that does take the break-even to about $56, $57. That's an interesting one. Then he will have to forego that. And I think that's going to be the big question mark. Is he willing to do that? Or does that bring Russia back to the table for negotiations?
Where is Saudi Arabia's break-even?
At least $25 above Russia. So I'd say in the high 60s, early 70s. They've always said that they would prefer prices in the 70s.
I mean, John, to me, that's the heart of the matter. Is Russia's break-even is less than Saudi's?
Yes and no. There's break-evens and then there's thresholds. And I want to try to understand the pain threshold. Is it the break-even or something much, much lower, Amrita? At what point do these guys get together and say, you know what, we need to get back to the table? Because we've had a massive gap lower in crude overnight. And I'm wondering if we're vulnerable to a move the other way just as quick, with one headline from the Russians saying it's time to have an emergency OPEC Plus meeting.
Not yet. Like I said, I think Russia can absolutely sustain low oil prices for longer than Saudi Arabia, and they can go for months, years if required. Of course, they wouldn't like it, especially not with Putin's new policies, but they are not going to be the first ones to blink in our view. Saudi Arabia is far more vulnerable, especially given the kind of spending they have, right, in the Middle East as a whole, Syria, Yemen, and I think that's where the break-even, so that's why the break-even is so much higher.
Amrita, John was talking a lot this morning about the credit markets and all the debt tied to shale companies, and I'm wondering from your perspective how quickly this wipes them out, given the fact that we already had seen some stress in the buildup, given to how much oil prices had already declined.
Absolutely. I mean, we saw shale production rolling over in December of last year, even when prices were rising. And, I'm in Houston right now, but even in my prior visits, as late as January this year, they were telling me the biggest problem is there's no private equity money. There is literally no lending around because a lot of people have just lost interest in the sector, and shale companies haven't made money. And I think that's the biggest challenge they have now. With this oil price collapse, we are going to see a huge surge in bankruptcies. Again, I do want to highlight, shale's not going to be dead. The big companies will always survive. But the growth rates of, say, 2 million barrels per day that scared the market, those days are over. If WTI stays at $40 for a few months, so say up to 6 months, next year, U.S. production will fall by 1 million barrels per day.
So a huge surge in bankruptcies. Will this be substantially worse than what we saw 2015, 2016?
Yes, simply because we just don't have the kind of private equity money to come and shore up these companies. So it's going to be up to the oil majors to pick up some of these companies who have good acreage. And we all know a lot of these companies just simply don't have good acreage.
Amrita Sen, thank you so much. With Energy Aspects, greatly appreciated this morning. Again, these are new numbers we're setting with American oil, 32.09. Brent crude, 35.46. Tim Craighead, always writing for Bloomberg Intelligence, this on LinkedIn this morning. He's got a PE of the FTSE of 11-ish. I mean, PEs are adjusting.
This headline, crossing a Bloomberg, is going to unsettle a lot of people. The U.S. credit market fear gauge surging the most since the Lehman collapse. Lisa, you can weigh in on this in just a second, but I think this is the problem at the moment. We had Jeff Curry at Goldman on the program maybe a week or so ago. I think it was last week. He was talking about how equities are a anticipatory asset class and commodities need to clear at spot. Supply, demand. It's not about the hopes and dreams of the future. It's about clearing supply and demand at spot. Credit right now is moving into the following kind of zone. Just the very, very basics. Are you going to make your coupon payment? Are you going to make your interest payment? And for high yield and for the energy part, the energy complex within high yield, that's the question back on the table.
What have those spreads done in the last week? I mean, describe when you say high yield spreads, what do you actually mean?
That means the extra yield over benchmark rates that investors demand
and it's
to
5
own
percentage
that.
points?
It's 550 right now.
5.5 percentage
which
points.
Was around the levels that we broke out to in 18, 19. But if it's going to be worse than 15, 16, Lisa, we've got 700 basis points to go from Friday's close.
If the high yield energy sector is going to be worse than 2015, 2016, just add to that all the other sectors that are going to be affected by what we're seeing from the global slowdown.
So you go from 5 percentage points out to a difference in yield of 7 or 8 or 9.
I want to be really clear about what we're seeing play out, though. It's the pace of the move that is very similar to what we saw in 08. The absolute levels are still incredibly different.
I think that's an incredibly important point to highlight. What we're talking about when we talk about the credit fear gauge is the investment grade credit default swap index. And it is surging to the highest levels since probably 2016. I'm going back right now to since February 2016. But the actual pace of it is what is going to get a lot of people very concerned. And the question is, who's going to be forced to sell and what is that going to potentially do to the stress in the market?
I got a Luke Kawa chart. Luke put out a brilliant tweet on the 10-year yield volatility, and John, as you mentioned, it is back to Lehman areas. It's not through the Lehman panic, but it's getting there rapidly. I'd also note I'm watching to 4 digits, the 30-year yield, the old benchmark. John, you're trying to remember when the 30-year yield was the benchmark, 0.8503.
I'm old enough to remember when it had a yield of 3%, 4%,
but it's key that's lower than it was 2 hours ago. This is bond price up, yield lower in the last few hours. Lisa Bramowitz, John Farrow, and Tom King, you need to stay with us. Really a special edition of Bloomberg Surveillance this morning with less commercial interruptions. Lots going on. This is Bloomberg.
Why do hedge funds and other alternative managers rely on Pershing for a highly personalized experience? Mark Alderati, a managing director at BNY Mellon's Pershing and head of Prime Services, explains.
In today's fast-paced environment, where the only constants are change and volatility, you need a prime broker who's both steady and agile, focused on supporting your needs so that you can focus on growing your business and producing results. Exceptional client service and advocating for our clients is at the core of what we do. Our award-winning high-touch team is just one of the benefits of working with BNY Mellon. We help alternative investment managers create great experiences for their clients. Whether it's customized financing, securities lending solutions, platform access, or outsourced trading, BNY Mellon's Pershing is a prime broker who's committed to this business and dedicated to meeting your evolving demands.
To learn more about the unique and industry-leading solutions for hedge funds and other alternative managers, visit Pershing.com. Pershing LLC. Member FINRA, NYSE SIPC.
Message and data rates may apply. T&C and privacy terms can be found at babbel.com/terms. Please don't text and drive.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then try Babbel for free by texting EXPLORE to 64,000. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just text EXPLORE to 64,000 and start your first lesson in the language of your choice for free. Download the Babbel app or text EXPLORE to 64,000 and try it for free. Text EXPLORE to 64,000.
This is a Bloomberg.
Delayed at the dentist and now you're late for school pickup. You need a free now. Need to take the dog to the vet before lunch. Should have gotten a free now. Trying to get 4 kids and their baggage to the airport? Free now. Sometimes you can't get from A to B fast enough. Download the Free Now app today for quick pickups and reliable drivers, no matter the situation. Less hassle, more hustle with Free Now.
Hey, have you heard? The Mayor of London has launched his latest van scrappage scheme to help tackle London's toxic air. Small businesses or sole traders like me with a polluting van could now get £7,000, which you could use to trade up to a Euro 6 vehicle. And you could get an extra £2,500 towards running costs if you go electric. The scheme is now even easier to qualify for, and it's open to any businesses with up to 50 employees, like mine. So, I'm going to search TfL scrappage to see if I'm eligible and apply. You should do the same. To the Mayor of London and TfL. Every journey matters.
Matt Letizia, what did you make of that performance today?
Well, it really was a game of two halves, to be honest, Jeff. Leicester came out in the first half really...
Letiz?
What's up, Jeff?
Run for it!
What the...
Move over, football. Cheltenham coming through. And Sky Bet are on the charge. With money back as actual cash, up to £10 if you lose on the first race of the festival. Sky Bet. That's betting better. Applies to first bet on first race at Cheltenham on losing singles and win part of each way singles only. Money back as cash. Free bet stakes excluded. Eligibility restrictions, T's and C's apply. 18 plus. BeGambleAware.org.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Bloomberg Surveillance.
From New York City, for our audience worldwide, this is Bloomberg Surveillance live on Bloomberg Radio, where equity futures are limit down and have been that way overnight and through to this morning.
Worse than that.
Your read on the equity market, Tom, comes from the SPY, the S&P 500 Spider ETF. That is down 6.5% in pre-market trading.
And the 30-year bond just went to a lower yield. Folks, I really can't convey how we go to 4 digits on the yield, like think 3.3256. Well, nobody quotes that. But here at the zero bound, 4 digits, particularly for our global Wall Street audience, has a lot of value. John, I got depressed this weekend, and it wasn't over that every room in the house has a bottle of Tito's vodka because, one of the kids...
Because we were apart for more than 24 hours.
That's a sanitizer. It's our sanitizer that we have in the house. Can you imagine the Arsenal-Tottenham derby empty? I mean, can you imagine that?
Juventus-Inter yesterday afternoon.
What was that like? Did you watch it?
I watched it. Empty stadium.
Really strange.
No fans. players didn't shake hands, but they jumped all over each other when they celebrated, which I just found ridiculous. See, that, you're not going to shake hands for hygiene reasons, but then when you score, you jump all over each other. But was that the future that we saw over in Italy last night, where over the next couple of months we're going to see more sporting events played behind closed doors?
That's a good question. Also about the access to locker rooms. That was one of the focus points in the United States, where they were limiting
access.
Is this
appropriate conversation for radio?
It's a locker room discussion.
I think Lisa was keeping it PG. I don't know where your mind's racing to.
Excuse me.
Meanwhile, over in markets.
30-year bond now, seriously, through 0.85. I got to get that chart up right now. We can do that on the Bloomberg terminal. We're really making an effort, folks, to send out more charts today. We do that typically through Twitter and through LinkedIn, depends on what our schedule is. The spike in the 30-year bond, John, was a 1%. Down we go to 0.70 for a cup of coffee. And we come back, and critically, John, before you bring in our next guest, we've rolled over in the 30-year bond a lot with a lot of other indicators as well.
Just a massive bid. The front end coming down 24 basis points. We're down 44 basis points on a 30-year yield. These kind of levels that we're hitting, I think we've cut the yield on a 10-year by 2/3 or something, more than a half in just 2 weeks.
It's incredibly dramatic, and I think that the focus today will increasingly be on credit markets. You've been talking about this, John, and I think that people realizing that the field has just changed dramatically. I'm looking right now for an early gauge before the bond markets open in a half an hour. HYG, which is the biggest high-yield bond ETF, in pre-market trading down 4.5%.
Ouch.
This is going to be
just perspective here, Lisa, because I think it's really important to see the equity market down 3-4% is one thing. To see that down 3-4% is quite another.
It's quite another, especially considering the fact that you have a rate component trying to buoy it, right? I mean, this is going to be a dramatic day in credit.
Should we talk to somebody who was in the Forpal Leverage Strong Yen Fund?
Shall we?
That would be Kit Hughes of Societe Generale with us. Kit, you've got decades of experience. You write a must-read on Wall Street. I'm going to call it a 3-paragraph essay this morning. The Jukes Way, folks, is incredibly terse and compact. Be terse and compact. What do you observe this historic morning?
Look, this is we're going to worry about margin calls and positions getting floated out. This is an oil price collapse that came after everything that came with the coronavirus, and the mix together is just throwing positions out. But you're right, we're going to be really close to having the biggest single day fall in 30-year yields since the bull market started in 1982.
Just unreal.
The movements are there, but this is really important, Kit Hughes. Chris Verone over Strategas, who's a real student of history, he's still getting carded, he's so young, and he says the big trap here is to look back to 2008. He goes back to 1987, and critically to the joy you and I shared on that August weekend in 1998. Is this of a 1998 level of sweat?
Please, yeah, I think so in terms of, in a sense, you'd like it to be. I mean, I point that out. So in 1998, where the Fed had to ease aggressively after the problems we had with long-term capital, U.S. retail sales were up by more than 1% in the next 2 months. Main Street took one look at what we were doing up in Greenwich and didn't care. That would be bliss. There was then, obviously, the Asian crisis, the problems with Russia, everything that went through, and it was huge. But I think that the piece that's most similar is that what we're worried about now is dominoes falling in markets, which adds to all the other problems we have.
Kit, what's so crazy about this, and I'm not sure if it's a comfort or a worry, we haven't even really seen the data yet.
No, I think the data are less important right now than the market positioning. I think that's the
interesting
thing. Last Friday's data were fine in the U.S. I mean, that was a good payroll number by pretty much any definition we could usefully come to. We will get slower growth. I mean, let's not get confused about that. But just right now, in the short term, the euro's not trading at $1.14 because everything's fancy in Europe. The euro's up here because there were a lot of shorts, and they're being ripped out of the market very aggressively. The fall in yields is slightly different in the sense that we have a sense that central bankers cut first and think later at the moment. It's the default. It's the paracetamol of central banking reactions. We don't know if it helps, but it won't hurt.
Euro dollar just short at 115 overnight, Kit, just to jump in. The high of the session, 114.95. You've touched on something really important, though. We've mentioned that quote from George Soros from many years ago, that markets can influence the events they anticipate. You can shape the events you anticipate. Are you worried about that? Financial conditions just taking over here in the driving seat and dictating where things go?
I'm worried about it in the short term. I think central banks, because we went through 98, because we went through, and particularly because we went through 2008, central banks have got good at this. But the announcement at the weekend by the Saudis on just effectively letting the oil market find its place, definitely that catches everybody off guard, and they're not sure how to react. And we won't know how bad that is until we see, how it feels in the high-yield corporate bond market in the United States, which is probably where that's going to be felt most, where you'll see it reflected. But I'm less pessimistic than I would have been if we didn't, a crisis that comes through the financial sector is kind of what central banks have got better at in the last decade.
So central banks have gotten good at this. I want to talk about the move today, where you have the Federal Reserve Bank of New York increasing the size of this week's overnight and term repo operations. How close are we to some sort of systemic seizure?
I don't think we're. I don't think we're necessarily that, because remember, we're not in an environment where we're worried about financial institutions, going bust the way we were worried in 2008. It's not that kind of an event. What we have is, a lot of margin calls on a lot of positions. We have a lot of uncertainty. We have a lot of illiquidity because we've made the markets less liquid with the way that we've changed finance in the last few years. But I'm still, I'll be optimistic on that one and say that this is not a crisis that started on Wall Street and started in the banking sector the way it was in 08, which is, I go back to this time is different. This time it's more normal. This time it's not one of those terrible recessions that comes with a financial crisis. Ken Rogoff should not be as agitated as he was last time.
Kit Jukes with us with Societe Generale here at 7:38 Wall Street time. A deterioration of the tape. You cannot see it in SPX futures, negative 145. That is inaccurate. That's frozen limit down about 10 p.m. Last night. Right now about negative 6% on the ETF, the exchange traded fund of the Standard & Poor's 500. Thanks to Chris Nagy of Bloomberg Equity for really forcing that on us. Is a great market measure. Yields come in, the 30-year bond just simply plunging over the last 20 minutes from a 0.85 to 4 digits, 0.8255. I do want to make note, particularly for the many of you coast to coast beginning to work from home. We say it in passing every day, our Bloomberg digital product, to give you an expansion of that. It can be everything from radio.com to iHeart, of course, Sirius XM channel 119 across the nation. There are tune-in apps, and of course the usage at Bloomberg.com as well. And for those with a Bloomberg terminal at home, like John Farrow, glued to it all weekend, there is RADI, and then you hit the go button. Isn't that cute, John? Radio.
That's very cute.
Radio.
That's very nice.
Go.
That's cute.
Did you get that little Irish pub below where you live there with that view out to JFK and Long Island?
We're just going to keep giving away where I live.
The view out to JFK?
Should we give out the coordinates?
But you do have a view
over the
of
weekend.
JFK,
did you get a terminal installed in that pub?
Seriously?
Did you get a terminal installed in that pub?
I took him into said pub a couple of weeks ago.
I'm sure you
did.
Said pub. Let's talk about this move in the bond market. Yields down 45 basis points on 30s. A 10-year maturity coming in 35.
It's unreal.
I made a note of this last night. We opened last Monday 1.1%. The Monday before, 142. And at those kind of levels, people thought, wow, we're pushing the limits here on a 10-year treasury. Here we are, 41 basis points on a 10-year. Kit, just talk to me about the pace of this move over the last couple of weeks and how unprecedented something like this is.
Look, if we close here tonight, it'll be the biggest single-day move, let alone what we've done over the last week. I'll have to go and think about that. But say since the market rally started back in 1982, I looked those numbers up because Albert Edwards, my colleague, started then and wanted to know. But I haven't seen anything like this. But the challenge that comes from the pace, by the way, is my thought last week, as we looked at the report, is that why is everyone shocked by how low Treasury yields are, given that we can already see, the levels that we've got in Europe and Japan. I mean, let's face it. When I'm talking minus big minus numbers on a 30-year bond, I mean, a 30-year bond, is minus 54 basis points at the moment. So, if you had to ask me to bet whether we were going to get Treasury yields to zero at some point before this whole moves out, we will surely at some stage. So, this is one of the reasons that makes it accelerate. If the Fed is going to go down the path we've all gone down, we'll get to the same place.
Kitchux, thank you so much for decades of perspective and your commitment to Bloomberg surveillance as well. The German 2-year yield down to new lows, negative 0.96. With our news in New York City, here's John Tucker.
And Tom, John, and Lisa, global fatalities from the coronavirus have reached 3,800 as infections spread to about half of the world's countries. Columbia University in New York and one of the most affluent towns in America have suspended classes amid coronavirus concerns. New Yorkers should avoid the subway at rush hour by cycling or walking to work or stay at home and telecommute as Mayor Bill de Blasio outlined plans to fight the coronavirus. New York City has 13 confirmed cases. National Institute of Allergy and Infectious Diseases Director Dr. Anthony Fauci cautions a vaccine is likely a year or more away.
For now, the answer is not going to be a vaccine. If, in fact, we go into a cycle where we come back next year, then we likely would have some opportunity for a vaccine.
In the midst of the coronavirus outbreak, President Trump replaced the White House acting chief of staff director Mick Mulvaney with Representative Mark Meadows of North Carolina. Several of Mr. Trump's aides pointed out that polling has shown that chaos in the White House is one of the voters' top complaints about the Trump presidency. And this just crossing the Bloomberg, Spanish coronavirus cases jumped to 999. That's according to their health ministry this morning. As Senator Bernie Sanders campaigns in Michigan, Democratic presidential hopeful Joe Biden received an endorsement from that state's governor. Governor Gretchen Whitmer says she's throwing her support behind Biden because she remembers when the then vice president bailed out the state's biggest industry.
It was the Obama-Biden administration that helped out the auto industry in our toughest moments.
And news this morning that New Jersey Senator Cory Booker has thrown his support behind Joe Biden. That's according to the New York Times. On Sunday afternoon, Sanders received endorsement from civil rights activist Jesse Jackson. Global news, 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm John Tucker, and this is Bloomberg. Jonathan.
John Tucker, thank you very much. Some massive moves out there. JP Morgan down 9.5% in early trading. From New York this morning, good morning. This is Bloomberg Radio.
With the Bloomberg Business of Sports Report, I'm Michael Barr. A stadium employee who worked at a Seattle XFL football game tested positive for the coronavirus. King County health officials say the part-time employee at CenturyLink Field worked at the February 22nd game between the Dragons and Dallas Renegades. Officials say the risk of infection to attendees was low. The San Jose Sharks said that they were approached by the Santa Clara County Public Health Department to call off Thursday's NHL game against the Minnesota Wild to slow the spread of coronavirus. According to the Washington Post, the Sharks refused and the game went on as scheduled. The team says its arena undergoes a rigorous cleaning procedure after each and every event. The Madison Square Garden Company said that a veteran MSG executive would become president and CEO of its sports business following a proposed split. The executive, Andrew Lustgarten, now serves as MSG's president. And that's a Bloomberg Business of Sports report. I'm Michael Barr.
Vatsal Shah is Senior Project Engineer at Mott MacDonald, a global engineering consultancy with more than 16,000 employees. He earned his PhD at New Jersey Institute of Technology, and as an adjunct professor, is helping NJIT students explore emerging technologies.
My focus is renewable markets, emerging technologies, the idea of floating cities. What are we doing to develop that? What will happen to the city on the water? Well, you're going to have waves hitting it. You're going to have solar. How are you going to develop plants? How are you going to develop vegetation and farming? That sort of thought process happens at NJIT. We actually plan out what will the city look like. How do we develop that? So in 10 years, we're actually ready to take on those challenges when we have our first development in the water. NJIT also has been doing a lot of work in self-healing materials, so taking the polymers and the new material that we have in our material sciences departments and putting them into things like concrete, things like steel, reinforcing our soil.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And then they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
On average, in London, a scooter or motorbike is stolen every hour. Make sure it's not yours. Lock your bike, chain the rear wheel, and cover to make it harder to steal. Lock, chain, cover. The Met Police.
We've all been in one, but how much do you really know about black cabs? For instance, did you know that a black cab has to be tall enough to accommodate an individual wearing a bowler hat? That's a lot of space for you and your briefcase. Or that Free Now drivers can use the bus lanes, the perfect getaway to make your meeting in time. And with 2-minute central London pickups, you needn't waste time searching for a taxi. Just download the Free Now app today and take the hassle out of getting round London.
How do you make the most understated Range Rover even more striking? Paint it Santorini black, fit it with privacy glass, a full leather ebony interior, then place it on 21-inch gloss black alloy wheels. The Range Rover Velar R Dynamic Black, understated, has rarely been so bold. Limited numbers available for a limited price. Search Range Rover Velar, Land Rover, above and beyond.
Limited availability while stocks last at participating UK Land Rover retailers. Check with your local retailer.
And breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
And up here in Moscow, oil prices are plummeting, equities are plunging, and currencies and bonds saw wild moves as the world heads for a full-blown price war in crude, and panic appears to grip financial markets. S&P futures fell about 5%, triggering trading curves. The whole U.S. yield curve fell below 1% for the first time in history. We check the markets every 15 minutes throughout the trading day on Bloomberg. S&P futures down 145 points. Dow futures down 1,255. And NASDAQ futures down 410. The DAX in Germany is down 7%. CAC in Paris down 6.8%. And the FTSE 100 down 6.6%. 10-year Treasury up 3 and 19/30 seconds. Yield 0.40%. The yield on the 2-year 0.26%. 30-year yield 0.83%. NYMEX crude oil is down more than 22%. Down $9.24 at $32.04 a barrel. COMEX gold is up 0.3% or $5.40 at $16.77.80 an ounce. The euro 1.1423 against the dollar. British pound 1.3074 and the yen at 102.28. And Aon agreed to buy Willis Towers Watson in an almost $30 billion deal. All cash transaction. It was announced a year after the previous takeover talks fell apart. And that's a Bloomberg Business Flash. Tom, John, and Lisa.
Karen, thanks so much. John Farrow and Tom King with Lisa Bramwitz. What you need to know is not so much the data points. Karen just killing at that with the best in the world data check. Far more is a trend over a morning. John, to me, the number one message right now is that you open Asia ugly, and then usually in the vicinity of 3 a.m. things get better. That did not happen this morning. They've been stasis, and in the last hour it's deteriorated.
Yeah, to get a read on the S&P 500 this morning, you need the SPY, the Spider ETF, and in the pre-market we trade lower by 6.7%. We are limit down.
6.7?
On S&P 500 futures, we are limit down.
I can't do that,
and just to pick out some individual names, I just want to give you a sense of how much pain there is in energy and in financials right
if
now.
If you're in the triple leveraged all cash, you don't need individual names.
You're doing pretty good if you're in cash right now. BP is down 20%. 20%.
British Petroleum.
Down 20% in a single session. And the session's still not over. We are down that hard over in London. And here in the United States, JP Morgan, Lisa, down 9.42% in early trading. And it was down more than 20% coming into today's session on the year to date.
The big question here is how much is this pricing in low rates, zero rates for the foreseeable future? And how much is this pricing in some sort of systemic issue? Some sort of perhaps either, whether it's a freeze when it comes to the actual functioning or the actual just, breaches. That's not happening. But I think that what people are concerned about is a combination of both the incredible drop in rates, plus financial disruption in places like oil, that's going to become a pressure point.
I would suggest we're pricing in disinflation and deflation, which is a good reason to bring in Gina Martin-Adams, running all of Bloomberg Intelligence Equity for us as well. Corporations have to price in disinflation, deflation as well. Do they have sector to sector with your vast team that you've got? Folks, it takes up it's like a football field of securities research. When you look at your team, do corporations have the elasticity, the malleability to adjust to what we see on our screen?
I think it depends on what corporations. Obviously, energy companies are at the center of weakness.
Okay, but come on, away from that.
If you look
Toothpaste companies.
you look at consumer staples companies, you look at healthcare companies, you look at even technology companies, it's a completely different ballgame. So I think what you need to do is be a bit discerning within your equity market exposure. Obviously, the value and high vol stocks are going to continue to suffer. Obviously, the energy, some of the industrials and materials names are going to continue to suffer. But there are potential beneficiaries. And I think over the course of this day, you're going to see some cooler heads start to prevail, and you're going to see people start to think about, okay, what do 0% interest rates and $30 oil prices really mean for behavior longer term? And functionally, they mean it's effectively a tax cut for the U.S. consumer. Once we get through coronavirus, it's very supportive and very stimulative. It's hard to see in an environment of panic and an environment like this. But the reality is, in this cycle, we've dealt with a lot of shocks. 2011, we had a contraction in GDP growth for a quarter. 2015, we almost had a contraction in GDP growth as well. So I do think that markets are very, very volatile in the short run. But ultimately, this type of panic behavior creates an opportunity for investors.
What's the panic in the bank stocks, as John was talking about? What's that implying?
I mean, the bank stocks are also value stocks. Right? Value's getting thrown completely out. We did a little bit of analysis of the momentum relative to value trade. It's very typical that what you see in an environment of markets falling, value stocks fall the most. It also is a function of interest rates are falling, right? The yield curve is still very flat. Interest rates are falling, so there's an assumption the net interest margin is going to get squeezed. Obviously, capital markets activity is going to be very, very light for the first quarter at the very least because there's no activity. They're high beta, so they also are going to fall faster than the market. So they're unfortunately just in a bad position sort of structurally. Now, big stocks like JP Morgan, big companies like that, they're just these are babies that are getting thrown out with the bathwater.
I mean, I'm looking, John, at JP Morgan. I'm trying to do the math now. I think it's down 20-something%, 28, 29%.
On the year, through 2020?
No, from the peak. On the year base, from the peak. It's trading at 97 right now.
Dividend yield north of 3% on JP Morgan. On the likes of Wells Fargo, north of 5%. Obviously, in an environment like this, the dividend yields are going to look nice because the stock is adjusting so quickly, and the dividends may well change on some of these big energy players, on some of the big financials as well. I also think it's always worth emphasizing that point. But income in equities right now, it must look ridiculously attractive, Gina.
It is, though I think you, again, have to pick your spots carefully because if you sort of segment the income stream, the dividend income payers in the S&P 500, you look at the highest yielders, they're actually becoming higher and higher beta stocks. I mean, many of them are energy companies. Many of them are, you would qualify them as near junk
This is the risk.
Right, and that's the risk. So you want to be really careful on the dividend sustainability as you make that point. I actually don't think the financials dividend sustainability is an issue at all. I think it's very sustainable. The financials never took on leverage this cycle. They're very low leverage, especially relative to where they were in the last cycle. However, the energy companies are certainly at risk, and you're seeing that reflected in energy stocks. I mean, small cap energy stocks dropped 10% on Friday. They're going to get absolutely crushed again.
But are they going to stay in business? Do they have the solvency liquidity issues that Lisa Bramowitz is talking about?
Some of the small caps, probably not. I mean, we've already seen a bankruptcy in small cap energy this year. We'll probably see a couple of more because it's not sustainable at a level of $30, $25. These companies will not be able to stay in business.
John, the 2-year German, 0.973, straight down. No capture yet.
Absolutely incredible. Gina, fantastic to catch up with you. What a morning. Busy for everyone. And thank you very much for being with us on Bloomberg Radio. The 30-year in Germany, your yield right now, negative 55 basis points on a 30-year maturity over in Germany. A ridiculous rally taking place in the global bond market. In the United States, Treasuries just ripping at the open overnight. Yields down 47 basis points on 30s, on 10s down 36, on a 2-year down 24 basis points to 0.26% as we continue to model zero rates in the United States. Your equity market check brought to you by the SPDR ETF this morning, because S&P 500 futures are limited down, and in early trading we are down by 6.5%. From New York this morning, good morning to you all. This is Bloomberg Radio.
Not completing.
I can find and fund my car, from a Mini to a Jaguar.
Feel good car buying from findandfundmycar.com is the place where you can find quality used cars from trusted dealers rated by you, and where you can fund your car with finance to fit your budget. It's feel good car buying all in one place.
Shouldn't be a carry on, choose findandfundmycar.com.
Whatever job you're searching for, you can find it on LinkedIn. First jobs, flexible jobs, work from home on a Friday jobs, advertising jobs, accounting jobs, HR, PR, even ER jobs, Soho jobs, Shoreditch jobs. Keep me away from the central line jobs. Banking jobs, building jobs, never ever boring jobs. Small jobs, big jobs, lunch in Borough Market jobs, or even voiceover jobs, which is how I ended up recording this ad. Search millions of jobs on LinkedIn and find one meant for you.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And then they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
On average, in London, a scooter or motorbike is stolen every hour. Make sure it's not yours. Lock your bike, chain the rear wheel, and cover to make it harder to steal. Lock, chain, cover. The Met Police.
A half-price dream holiday, wouldn't want to miss that. A takeaway for free, wouldn't want to miss that. And 30 gigs data for just £10 a month on Smarty Mobile. You definitely don't want to miss that. Our Smarty SIM comes packed with 30 gigs of data and unlimited calls and texts for just £10 a month on a 1-month plan. That's why Smarty won Best Value SIM-only network in the U-Switch Mobile Awards 2020. Don't miss out. Search Smarty Mobile. Smarty. Simple, honest mobile. Smarty.co.uk.
Delayed at the dentist and now you're late for school pickup. You need a free now. Need to take the dog to the vet before lunch. Should have gotten a free now. Trying to get 4 kids and their baggage to the airport. Free now. Sometimes you can't get from A to B fast enough. Download the Free Now app today for quick pickups and reliable drivers, no matter the situation. Less hassle, more hustle with Free Now.
The puck drops. 12 players face off to win. The suspense is pure torture, but you wouldn't miss this for the world. TuneIn brings you every minute of the NHL season. Listen live to hockey when it matters most on TuneIn.
This week on the New Yorker Radio Hour, we'll ask whether America is ready to elect a Democratic Socialist for president. Plus, the science fiction legend William Gibson on climate change and the end of the future.
How often do you hear the phrase, the 22nd century? Don't hear it. We no longer have that sense of cultural anticipation.
Listen to this episode of the New Yorker Radio Hour on TuneIn today.
Like what you're listening to? Want to make getting back to it easier? Use the favorite button to keep track of the stations and podcasts you love on TuneIn. Just tap or click the heart icon to add it to your favorites. Then find all your go-to audio under the favorites tab. Pretty easy, right?
Benefit if you're just further away from China.
So that you can too.
What are the ramifications if she crumbles or doesn't crumble?
Bloomberg Radio, the Bloomberg Business, Radio.com, and iHeartRadio apps, and BloombergRadio.com. Bloomberg, the world is listening. From the financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. This is Bloomberg Surveillance Economics.
The good news is the economy is strong. The bad news is the economy is strong.
Financial crises take a really long time to recover from.
Finance.
The strong job market's pulling people back in.
You can't have for very long, monetary union without a fiscal union.
Investment.
What we preach is extreme diversification.
It's hard to have sustained productivity without capital investment.
Bloomberg Surveillance with Tom Keene and Jonathan Farrow on Bloomberg Radio.
Good morning, everyone. You know of the virus. You know that the markets are crashing as they've done Thursday, Friday, and worse today. We'll give you those data checks through the hour, but far more, what can institutions do? We welcome all of you on Bloomberg Radio worldwide, particularly on our digital product with so many people working at home. Good morning on Sirius XM, Channel 119. John Farrow, Tom Keene, and Lisa Abramowitz. Absolutely extraordinary markets. We've got two incredibly important guests in this half-hour commercial free for you. Francisco Blanch will join from Bank of America, and then Dr. Alarian will join here in a moment. John, let's keep this shorter this morning to get to Dr. Alarian in this hour. I would say I'm watching yields just simply come in, but I know you're not watching full faith and credit. You're watching credit.
Yeah, looking at high yield spreads where we closed through 550 on Friday and took out the December 2018 wides, and now we're thinking about 2015, 2016, Lisa, and that was the last time we had a mix of a crude shock and a growth scare put together.
Yeah, I'm looking right now at HYG, which is the biggest high-yield bond exchange-traded fund, just to get a view on what we can expect from credit today. It's plunging 4.8% ahead of the market open. Just to give some perspective, I was eyeballing it. That looks like the biggest decline. It will be the biggest decline if it reads through since 2008, just to give you a sense of the scope of today's moves.
Well, look at two numbers here. The German two-year yield, those two-year papers, maybe central bank indicators. The German two-year right now at a record lows, not to a negative 1%, but negative 0.976 as well. And in the equity markets, when you look at the ETF, because the futures are shut down, limit down, John, what did you say, 6%?
We are down by 6.5% on the Spider S&P 500
right
ETF.
Now. John, bring in Dr. Alarian here. I know he visits you at 9 o'clock because he doesn't want to get up that early to talk to me. Why don't you bring in
it's a special morning
as well?
It's a special morning. Good friend of mine, a good friend of the program, of course, and the gentleman that ignored the happy talk of the V-shaped recovery in the middle of February when the equity market was hitting all-time highs. A gentleman who said do not buy that dip when many people ventured back in as we got that initial correction. I'm pleased to say he joins us now. Mohammed Al-Arian, Allianz Chief Economic Advisor and Bloomberg Opinion columnist. Mohammed, let's begin with credit. Why is that so much of a bigger focus on a morning like this morning?
Because it is the way in which the disruptions will transmit through not just market segments, but the real economy. Credit has been vulnerable because it has been very decoupled from the underlying fundamentals. So when you shock it, as is being shocked right now, by a combination of no economic anchor, no technical anchor, and no policy anchor, what you're going to get is illiquidity, price gapping, and the closure of the primary issuance market.
So primary's been seized up for a couple of weeks. It opened a little bit last week. Let's unpick some of these different themes. I want to start with a parallel that we can draw at the moment. Clearly, we've gone beyond December 2018. Is 15-16 the last time we had a crude rout and a growth shock? Is that a decent playbook for you right now, Mohammed, or is this radically different?
It is decent because that fall in oil prices was triggered by the same thing that this one was, which is the decision of Saudi Arabia to no longer play the swing producer role in an attempt to impose discipline on other oil producers. So the cause is the same. However, the context is more difficult. First, because global demand is slipping very quickly. And second, because now you need Russia to turn around in a very humiliating fashion. So this one is going to be a little bit trickier for Saudi Arabia to achieve what it's trying to achieve.
Mohammed Al-Arian with us, folks, with Allianz, and of course writing for Bloomberg Opinion, of course joining Cambridge University here in the autumn. Folks, one of the books you can read in this if you want to grab onto something is Dr. Al-Arian's The Only Game in Town. Look for the movie 4th of July 2022. I believe DiCaprio's in that movie. Dr. Al-Arian, in The Only Game in Town, let me quote from chapter 1. Like ancient doctors who tried to explain the causes of diseases while knowing nothing about germs or bacteria, academics sought to describe the functioning of developed economies, etc. The great Ferdinando Giuliano, who writes for Bloomberg Opinion as well. How are we doing with the germs and bacteria this morning? How are our institutions doing in understanding where we are?
Well, they're starting to wake up to where we are, but they are having to play massive catch-up. Tom, you and I have been discussing this for years. We've over-relied on central banks. Central banks themselves got caught hostage by markets. We lost a lot of policy flexibility, and most importantly, we did not invest in what genuinely produces economic growth. So we have massive catch-up to play. It can be done, but it requires a complete change in mindset.
The single most important question, Dr. Larian, at Davos was John Farrow to a guy running a hedge fund, and he said the cycles out there, the boom-bust, don't function the same at the zero bound. We're more at the zero bound than we were in January in Switzerland. We're at the zero bound. Does the cyclicality of the financial system still work?
Oh, absolutely, and you're going to see it. We're going to overshoot on the way down because technicals are now in control. And the big risk is not only do we converge quickly to the most sluggish fundamentals from elevated asset prices, but we overshoot them. So cycles were never dead. I think we got complacent in so many ways. And the last 8 weeks illustrate to you how complacent we became. You had that comments out of Davos. We had a G20 meeting in which the coronavirus was hardly discussed, and now we're all waking up to the realities on the ground.
Can we just talk about the economics of fear, just very quickly, Mohammed? It's something you've written about over the weekend, and I think it's something that would be of interest to our audience as well. Walk us through that dynamic.
It's very simple. When you are taking out of your comfort zone, behavioral scientists will tell you two reactions are most likely: paralysis and insecurity. And we are being taken out of our comfort zone by the coronavirus, which means that we are paralyzed in terms of economic activity, which means we become so insecure that we become too risk averse. We exaggerate the probability of getting sick, and that results in demand and supply destruction. I remember right at the outset of this coronavirus fear, I told you guys on the radio, and I remember exactly where I was. I was at an airport when I told you, remember the notion of economic sudden stops. It doesn't occur in modern-based economies. It occurs mostly in fragile and failed states, but when it occurs, it is particularly dangerous because it destroys both demand and supply, and that is what we're living through right now.
Mohammed, let's talk about the salve to that culture of fear that we see pervading through markets, that we see when you go to the grocery store and you see Purell being hoarded behind the counter with a sign that says only 3 per customer. I want to talk about the Fed's role. And Boston Fed's Rosengren on Friday came out and hinted at the potential for the Fed to engage in ECB and Bank of Japan style asset purchases, saying in a situation where both short-term interest rates and 10-year Treasury rates approach the zero lower bound, allowing the Fed to purchase a broader range of assets could be important. Do you foresee the possibility of the Fed buying corporate bonds and stocks from here?
Lisa, I foresee a whatever it takes policy approach that is going to be both in central banks and government agency. But having said that, it's important to understand what the Fed can and cannot do. The Fed can support balance sheets. It can do so. It can put money in people's hands and support balance sheets. It cannot restore the type of confidence needed for economic activity to pick up. So the Fed has to understand that it's using policy ammunition in a very ineffective way. And it's got to make a judgment as to when to use it. I was against the 50 basis point cut last week. I thought it would do nothing at all, and it would take away policy flexibility. That's what happened. The most important thing for the Fed, and its major responsibility to the system, is to laser-like focus on market functioning, understand how markets are functioning, better understand market technicals, and address the pockets of liquidity that are going to arise and that risk becoming systemic. That is what the Fed should be doing. It should not be trying to flood the system in a way that's going to end up being very inefficient and use up flexibility that we will need later on.
Mohamed El-Erian with us, and he will continue with us in moments. We'll have in a couple minutes, I should say, scheduled to have Francisco Blanche of Bank of America on oil down what, John, 20%? Is that a general statement?
That's the move in crude, but the move in futures, obviously we're limit down, so we can get you an early read on the S&P 500 through the SPDR S&P 500 ETF, and we are now session lows, down a little more than 7 percentage points.
I'd also note the German 2-year as well, 0.975 is one of those global litmus paper, 30-year bond, a little better in the last 20 minutes. Why don't you pick it up, John, with Dr. El-Erian?
Mohammed, many people today, of course, will draw parallels between now and 2008, and obviously for many people, we are nowhere near that situation. It was a different world. But are you just as concerned about corporate balance sheets as you were about the household balance sheet back then?
No, John. I mean, ironically, this is not 2008, which is both good and bad. It's not 2008 in a good sense because I'm not worried about the banks, and therefore I'm not worried about the payments and settlement system. Remember, the payments and settlement system is the nerve center of any modern-based market economy. If that is no longer functioning, everything will stop, and that was the reality of 2008. So there's a good way that we're not similar to 2008, but there's another way we're not similar to 2008, which I worry about. The extent of global policy coordination is much lower. And whether it's the coronavirus, whether it's the excessive reliance on liquidity, whether it is markets that have been mispriced for a long time, this is a global problem that requires collective actions. So the bad thing relative to 2008 is that we're not going to get a London summit quickly that will allow to put an economic bottoming. We need advances on the medical side, and that's going to require a lot better global coordination.
Mohammed, when does the sell-off that we're expecting to deepen in the high-yield bond market, in credit markets more broadly, when does it become a buying opportunity?
When you get distressed levels. So I'm excited in the sense that as much as the immediate period ahead is going to be very treacherous, as much as that we are going to have massive opportunities, but understand where these opportunities are going to arise. They're not going to arise by buying a passive index and just betting on the whole marketplace. It's going to be very selective. It's going to be in distressed credit. It's going to be in structured credit. It's going to be in relative value, and it's going to be in good companies with strong balance sheets, high cash, that are trading at bargain prices. That is where the opportunities are going to arise. It's going to start selectively. And then when we start seeing high probability of medical advances to contain the spread of the virus and increase immunity through vaccine, then we're going to establish a bottom for the more general investing through index buying.
Mohammed, before we let you go, just a final question. Tom brought up your book, The Only Game in Town, and I know you were running up a new edition, and I was looking forward to it coming out later this year. Do you need to rewrite the start all over again and get back to it?
Yeah, it's a pain because the ebook is coming out in just a few weeks. And the reason why I wanted to bring it out, because when it came out in 2016, it was too early. My timing was way too early. People didn't realize what happens when you rely excessively on central banks. That we were planting many seeds of future economic and financial malaise. So that's why I wanted to bring it out again when people have realized that that's where we are. But the coronavirus pressed fast forward on everything.
Mohammed, great to catch up with you. Been looking forward to the release in a couple of weeks' time. Mohamed El-Erian there, Allianz's chief economic advisor and Bloomberg opinion columnist on the road ahead. We're going to hear a lot of these parallels, the differences, the similarities between 08. The starkest difference for me, when you hear people this morning, Lisa, talk about where high-yield spreads will blow out to, 550 at Friday's close. You go back to 08, we were talking about 20.
Yeah.
Different world, completely different world, and I think we should be very careful about how we throw around that year 2008. For me, what stands out in this moment and why you keep hearing since 08 is the pace the size of some of these moves, not the absolute levels we've got to, very, very different world, but just the pace and size of moves have just been pretty brutal.
And I think the question is going to be, how vulnerable had the market become to that shock based on the levels, the valuations that we had gotten to? I will just say Chris Rupke over at MUFG Union Bank, writing out in a note, the day the bond market died. And he talks about mark your calendars and tell your grandchildren that this is the last day of music stopped playing and the bond market died, talking about 0% rates for the foreseeable future.
But I would go to price. And Gary Schilling is saying that the day the bond market didn't die because he's long all this stuff and long duration, and he's making out like a bandit. Price up, yield down. So it cuts both ways. There's been this massive call. Credit Suisse had the best math on this over the years. They'd have a series that shows yield, and John, they'd have a dot chart off of it, little feathers off of it, of where the forecast was. Lisa, the street's been wrong on higher yields since time began. I mean, through this entire process. Brazilian real just opens up. John, you were talking correctly earlier that a 2% move in FX is a huge deal.
Yeah.
Brazilian real this morning is 3.6% moving out from a 463 out to 4.79. My sophisticated analysis is whatever, we can't see what's going to happen other than the deep litmus paper of a system says this is not good.
We've made the point a couple of times on the show over the last couple of weeks that when things move this quickly, other things break. We talked about the FX market overnight. I'm sure it got a lot of attention when you saw some of the oil currencies, the commodity currencies, like the Norwegian kroner, with a move of 4-5 percentage points against the US dollar. Lisa, just absolutely huge moves in foreign exchange overnight. And I get it. It's Asia. It's the open. It's one of the whippiest parts of the session. You can have these kind of gappy moves, but just seeing some of these moves is still, nevertheless, quite staggering.
One thing that Priya Misra of TD Securities was saying over the weekend that I thought was really important was there is a question about liquidity in some of these markets where algorithmic trading has taken on such a huge part of the volumes. Algorithmic trading tends to wane, tends to pull back during periods of high volatility, leaving the rest of the market. And the question is, if the rest of the market's actually shrunk, how is liquidity functioning? And these are going to be some of the questions we're going to be digging into.
Questions we'll ask over the next couple of hours. In the equity market right now near session lows on the S&P 500 SPDR ETF in early trading down 7.2%. But front and center overnight and through the weekend, the shock coming to the oil market. We gap lower on Brent by as much as 31%. We're down 22% right now. $35 a barrel on Brent. On WTI, 32. Joining us on the phone, I'm pleased to say, is Francisco Blanch, Bank for America, Global Head of Commodities and Derivatives Research. What a pleasure, a privilege to have Francisco with us on the show on a morning like this morning. Francisco, let's talk about the potential that OPEC Plus, together with Russia, can get back together at some point in the near future and strike a deal.
Hey, John. Thanks for having me on the show. I am not sure. I am not sure if they'll come in and have a deal anytime soon, because it's not clear what the rationale behind this last move has been. I think the Russians were very reluctant to cut supply to begin with to deal with this virus. They made their position very clear to the Saudis. The Saudis wanted to cut 1.5 million barrels a day of supply. That's the proposal they held on the table last week. And ultimately, either the talks broke down, which is one possibility, or maybe the Russians swayed the Saudis and convinced them that maybe, it's not so bad to let the market run its course and ultimately clean up the U.S. shale sector. Both have been wanting to do it for a while, and I guess this is as good an opportunity as ever.
I see in all the research notes this morning from the sophisticates like yourself, Francisco, everybody's talking about hedge exposure. Forget about like Russia loses, somebody wins, Brazil loses, whatever that kind of macro baloney is. Explain the hedge exposure right now. Who loses the most when you see a 20% move in something that's supposed to be certain?
Well, I think the people that will probably end up losing a lot is those that have hedging mismatches. So there could be trading houses, traders, potentially some broker dealers that have exposure to this, the principal exposure, that is, not if you're a broker, but if you're a broker dealer, and it could also be, and frankly, the biggest losers are going to be the oil companies themselves that have not hedged. And And remember, a lot of companies were underhedged because at the end of last year, we had something called the Phase 1 U.S.-China trade deal, which was supposed to put the global economy back on track. We were supposed to see a restocking cycle of manufactured goods. We were supposed to see a stronger economy. And I think a lot of people may have actually just lightened up on their hedging heading into the first half, and those are the ones that are going to be hurt the most. Now, who benefits? I think it's going to be consumers benefiting here. Obviously, consumers in many parts of the world are not really traveling that much because of the coronavirus. But if you are able to travel, you're going to get a pretty good deal with the drop in fuel prices that we're seeing right now.
Francisco, I'm looking right now at the cash bond market, the high-yield bond market, which actually opened at 8 on Wall Street, and we're seeing just some violent moves in the shale debt. We're looking at 40-cent moves lower, huge kinds of shifts, and I'm wondering, going forward, is this going to reshape the shale industry profoundly and actually curtail production in the U.S. for the longer term?
So I think the answer to those questions, both of those questions, is yes. We will see a curtailment of production, and we will see a profound impact on the industry. Remember, this industry has been already hit in all fronts. During the 2010s, the industry probably wasted about $130 to $140 billion of investor money, both in terms of equity and debt issuance. So very few investors actually want to own any energy to begin with. And I think this last blow is going to hurt particularly the levered players, the smaller players. Those you mentioned high yield. Remember, high yields characterized not only because it has a wider differential to investment grade debt, but also because it has shorter maturity. So a lot of this debt is due in the next 12, 18 months, and that's gonna come to the front. And then the other thing that's going to happen is banks are probably going to look at their reserve-based lending practices and reduce the money that they lend the oil and gas developers against their assets. So we are going to see a very meaningful reduction in capital relative to where we were a month ago, which was already pretty bad.
With regards to that, Francisco, just to jump in, we're exploring different parallels. Just give me a snapshot of where we are right now, the supply-demand dynamic, just quite simply compared to where we were in 15, 16, when we saw these kind of things playing out. Night and day, similar, worse? What is it right now?
So I think from a demand standpoint, this is definitely way worse. We are going to see a global demand contraction this year, most likely, for oil. And we haven't seen one since 2008, 2009. So in terms of demand, it looks a little more like 08, 09 than it does like 15, 16. From a supply standpoint, it's unclear how much the Saudis are going to be ramping up supplies here. They've aggressively discounted their crude, and there is talk about Saudi increasing production over 10 million barrels a day, maybe over 11 million barrels a day. There's different numbers they're throwing around, but definitely is going to be almost just as bad as 15, 16. So it's almost in a way is a combination of 08 and 15, 16. Pretty bad for oil prices. That's what we think we could go back into the 20s here for Brent.
What is the ramifications of going back into the 20s for Brent and the equivalency to West Texas Intermediate for America's oil independence? Do we sacrifice that as Permian Basin shuts down?
We will definitely see a pullback in supplies, and it will hurt America's energy independence. But here's the good news. We know we can create America's energy independence again at prices of $40, $45 a barrel, which are still very, very good for consumers. So while I'm certainly concerned about the industry and certainly concerned about the potential fallout of this move, I will also say that if prices were to rise $10 a barrel, we would get the industry back up and running. So I think that it's definitely going to be a blow against the U.S. energy independence story, but it's a blow that is manageable for consumers. Now, the question we have to ask ourselves, is it going to be a big blow to some states, in particular like Texas and Oklahoma, as it was last time, or do they have a more diversified economy and they can handle it a little better? So that's I think, a big question mark out there.
This has been wonderful. Francisco Bunch, thank you so much. Greatly appreciate it with Bank of America this morning. Futures negative 145, except they're not, are they?
Can we just talk about that a moment? A demand profile that could be as bad as 08, with a big caveat, of course, because it might not be as deep for as long.
Yeah.
And a supply profile as bad as 15, 16, mixed together, taking Brent for the likes of Bank of America back into the 20s on Brent, and we're at 35.43 off the back of a 22% move. More downside seems to be the view on Wall Street.
It gets fixed to me. It's very stochastic charts in that they get overcome by events and then suddenly it gets fixed. And do we all agree that the number one way to fix it is Russia decides to have tea in Riyadh?
Well, that's the question, and I think Jean was bringing it up earlier, this question, how quickly do we get the recovery? And it doesn't seem like it will be that quick at this point.
Okay,
it seems like the heels
like
are kind of dug
away,
in.
Right?
Is it, though?
I mean, look, I need to understand thresholds. I talked to Larry Kudlow about this on Friday. If you're working on something, what's the threshold to deploy it? I'm thinking about that with Russia and Saudi right now. What's the threshold? Is it 25? Is it 20? At what point did these policymakers get together and say, we've got to make a change?
Yeah, but Francisco raised a point. For Russia to now tiptoe away and say, just kidding, because the oil prices went down, that threshold's pretty high.
Now, fractionally better tape in the last 10 minutes, and the 30-year bond, 0.91. That was 0.86 not too long ago. I'm watching the German 2-year as well, and the equity market's down, let's call it 6%. Stay with us. This is Bloomberg. Good morning.
Message and data rates may apply. T&C and privacy terms can be found at babbel.com/terms. Please don't text and drive.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then try Babbel for free by texting EXPLORE to 64,000. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just text EXPLORE to 64,000 and start your first lesson in the language of your choice for free. Download the Babbel app or text EXPLORE to 64,000 and try it for free. Text EXPLORE to 64,000.
Hey y'all, Jeff Foxworthy here. Now, if you've ever found yourself repeating the same thing over and over for 75 years, you might be Smokey Bear.
Only you can prevent wildfires.
That's why I'm filling in for Smokey to switch things up, because there's a lot more to say. And I should know because my grandfather was a firefighter. And one of the things he taught me is that the people that love the outdoors the most are often the ones accidentally starting wildfires, which means always BYOB. No, bring your own bucket to the campfire. And be extra careful with things like burning yard trimmings. Don't just walk away, or chances are you might be starting a wildfire. So for the love of the outdoors, go to SmokeyBear.com to learn more about wildfire prevention. Brought to you by the U.S. Forest Service, your state forester, and the Ad Council.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
On average, in London, a scooter or motorbike is stolen every hour. Make sure it's not yours. Lock your bike, chain the rear wheel, and cover to make it harder to steal. Lock, chain, cover. The Met Police.
We've all been in one, but how much do you really know about black cabs? For instance, did you know that a black cab has to be tall enough to accommodate an individual wearing a bowler hat? That's a lot of space for you and your briefcase. Or that Free Now drivers can use the bus lanes, the perfect getaway to make your meeting in time. And with 2-minute central London pickups, you needn't waste time searching for a taxi. Just download the Free Now app today and take the hassle out of getting round London.
This
This ad is made from 100% recycled commercials, just like Smart Water's
All new
bottles are made from
100% recycled
plastic.
What's that number again?
100%. Every Smart Water bottle is made using recycled plastic, and because it's still
100%
recyclable, the plastic will be used again
and again.
Smart Water, now in a 100% recycled plastic bottle. Label and cap 100% recyclable, but not made from recycled plastic. Yet. We're working on it.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Bloomberg Surveillance.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We are live on Bloomberg Radio. Your price action shaping up as follows on the S&P 500. Futures limit down over the last couple of hours, negative more than 5% seemingly. The story elsewhere, if you want to get a sense of where we are, the Spider S&P 500 ETF in early trading down a little more than 7%. Session lows there, and some of the individual movers, we've got some of the big banks on Wall Street down as much as 8, 9, 10%. The energy players getting hammered off the back of a huge move in crude. We gapped lower at the open yesterday evening, Tom, by as much as 31%. Brent right now down by 23.
Well, the Brent, the oil war and all that. Brent crude $35 a barrel, and you just heard Francisco Blanche of Bank of America talk about the 20s for Brent, which sets West Texas Intermediate even lower. But the correlative features here, Lisa, this morning, I'm watching German 2-year just as a challenge for Madame Lagarde and all that. It's done a little better fractionally in the last 20 minutes here at 8:31 Wall Street time. But the bottom line is yield is price up, yield down. And what I've loved this morning, folks, is listening to John and Lisa talk about the credit market, not the full faith in credit sovereign market as well.
Well, exactly to that point. Perhaps yields lower and lower if you look at the government bond market. If you look at the credit market, absolutely the other way. And I'm looking at HYG ahead of the open. It's just deteriorating. HYG is the biggest high-yield bond ETF to give you a sense of just the overall market move here. It is down now 5.7% ahead of the market open. That is the biggest drop, poised to be the biggest drop since 2008, to the point of the velocity that we're seeing in markets around the world.
What have been the flows out of that? Review, it's an ETF, right? So money comes out?
Flows out of credit funds have been some of the biggest outflows we've seen in years and years over the last couple of weeks. It's not been pretty at all. Lisa, on a day like today, just give us the guidebook, what you're looking at, because we don't get the read on the Bloomberg Barclays High Yield Overall Index until the close. Do you look at individual credits, some of the energy names in high yield? Do you look at some of the things that track CDS, the cost of protecting you on some of these indexes? What do you do?
Well, the CDX, the credit default swaps, we're seeing that index surge the most since 2008, and that goes up when people see the perceived risk going up. I'm also looking at just the bonds that are trading right now, and you're seeing the energy names just getting hammered, down 37 cents a piece.
Wow.
And what we're seeing is, it's 37 cents on the dollar, just massive gaps out. My question is, how much liquidity is there? How much forced selling? What types of BWICs are we going to be hearing about? In other words, how many people are going to be just trying to sell in mass because they are getting outflow requests? And these are sort of some of the questions that people have had for a while. We have not been seeing that kind of activity over the past few weeks, even amid the coronavirus concerns. Will this tip the scales, given what we're seeing now with oil?
Like the Tesla bond. I mean, just as one example, everybody follows Tesla equity, and Tesla's fallen off the radar with this crisis that we're in. But you wonder what some of these corporate pieces do. I guess they're on sale like equity. That's what Sir John Templeton would say.
We're coming down
Shares
a little bit, yeah.
Sale.
We're coming down 2-3 cents on the dollar on that Tesla 2025 note. Lots more coming up on the credit markets.
Yeah.
On the economy, a little bit later this week, you get a read on CPI and PPI, and I think everyone who looks at the February data is going to say the same thing. Who cares? Nobody cares. The focus, I think, is going to be on that first weekly read for the month of March on initial jobless claims, Tom.
Yeah, I'll go to the claims idea as well, and you wonder what the Fed's going to do this morning, and we've only touched on it a little bit with all the market gyrations, but all of this is a huge input of disinflation and deflation worldwide, and all the central banks have to catch up with that in whatever form they will. I mean, to our listeners coast to coast, are they going to enjoy disinflation here. Is college tuition or high school tuition, is it going to go down?
I hope it comes down if everyone's forced to work from home. If you're going to study from home and do these online classes, I hope they reduce tuition.
Speaking of which, nice seguity, Pharaoh. You killed that as well. We usually talk, folks, about our digital product, but we really want to outline for you because we know so many on Global Wall Street working from home. SiriusXM Channel 119, TuneIn apps, Bloomberg.com, of course, has good radio access as well. Bloomberg Business has it. Radio.com, iHeartRadio has it as well. And the Bloomberg Terminal, RADI Go is how they do that. RADI Go. You can listen to us working from home.
Working from home?
They do that okay?
Are you going to be working from home?
I don't know. We'll have to
find out as the week goes on.
Well.
Let's get a check on the economics worldwide, shall we? Jay Bryson, Wells Fargo acting chief economist, joins us now. He phones in. Fantastic to catch up with you, Jay. Your look ahead this week. What are you focused on in the data?
Well, we're not focused on the data. I think as you and Tom were pointing out, I don't think anybody's going to care about the data. The thing that we'll be looking at going forward will be the initial jobless claims number. Now, the one that prints on this Thursday is for last week. I think it's probably still a little bit premature to look for a jump in claims. It happened last week. But as we go forward, that will clearly be the key thing that I think we'll be watching in terms of the data, because that'll really give us a sense what's happening in the labor market and what that means for consumer spending going forward.
Jay, we've had people coming on this program for years now saying this is a tight labor market. Just to what degree will some of the corporates in America be reluctant to let staff go, given they might be worried about picking them back up in the second half?
Well, that's a really good question. And one thing that we've been focused on for the last year or so is the fact that the financial health of the business sector over the last few years has deteriorated somewhat. Now, I'm not saying it's awful, but it has deteriorated. And, with these shocks that you're seeing right now, these growth slowing shocks, the question is, in order to protect their bottom lines, do businesses then start to retrench? I think you're looking at a retrenchment in terms of investment spending. The question is, does it then spill over into the labor market as well? We'll see. I think you're going to see a wave of defaults occurring probably in the energy space, and then does that ripple out into other parts of the economy?
Jay, how likely is it that we get a full-blown recession in the U.S. in the next 6 months?
At this point, part of it is it really depends on what happens here going forward, particularly as it relates to the coronavirus, right? People are kind of buckling down now or hunkering down right now. Within 2 weeks, if this thing looks like it's topping out in the United States and people are going back to work and they're going back shopping again, then, the full-blown recession is relatively minor, I think, here. But, if we start to look like, a China or in Italy, where you're talking about quarantines and things of that nature, that changes the dynamic.
Jay Bryson with us with Wells Fargo. Jay, how do we import deflation? Walk through the mechanism of global slowdown, challenge commodity economies as well. How does that redound and come ashore in America?
Well, we are a relatively closed economy. So the way it happens is if the dollar were to really strengthen, and the dollar's actually going the other way right now. But, if you look at, imports of prices from around the world, if everybody else is slowing down, that's going to cause good prices to slow down here. But the real way you get, a deflation in the United States is, 2/3 of the CPI is services. And we import very, very little services. So the way you get it here in the United States is you'd have to have a pretty nasty recession so that service prices start to come, you have massive layoffs, wages really decelerate, and then, service prices come down as well.
And what's so important about that discussion, brilliant from Jay Bryson, Lisa, is the idea of we look at goods, trades, Long Beach, California, import, exports, and there's financial and actual service sector dynamics which make it different than the textbooks of 20, 30, and 40 years ago.
Yeah, the concern here is just going forward, the structure of the economy, and frankly, what type of intervention also would be required if we do get the style of shutdowns of what happened in Hubei or in now what we're seeing in Italy. And I'm wondering, Jay, we are hearing some talk about the Trump administration possibly getting together some sort of stimulus. What do you think would be most effective and warranted at this point?
Well,
Well, there's a number of different options here. I mean, one sort of different option would be to subsidize businesses so that they can, employees, can kind of stay home. That would be something. Another thing would be, a temporary payroll tax holiday. Now, if people are sitting in their apartments anyway, I don't know how much that sort of thing, actually helps there. But I think it's anything for, and another thing, and this kind of dovetails with, people staying at home and things like that. If you don't have health insurance right now, you could be sick, but you're still going to want to go to work, right? And so, one way to be able to do that again is to, pay companies or subsidize companies so that they can keep those sorts of workers. They can continue to pay those workers, and they can kind of stay home.
Jay, I was encouraged on Friday by Larry Kudlow and the White House that they're starting to look at some of these things. The unknown for me is the threshold to act. Are we still being held hostage by what the market does next? Or do you think policymakers realize now they need to try and get ahead of some of this, and really quickly, because they are very far behind?
Yeah, I think, obviously what's happening today, I think, is a wake-up call for policymakers in Washington. I think the Federal Reserve is pretty much on the ball here. It'll be interesting to see how much they cut as we go forward. And maybe we have to bring back some of these programs we had back during the financial crisis to liquidate different parts of the market. But the Fed can only do so much at this point. It's really going to turn to a fiscal policy response. And days like today, like this looks like it's panning out, that should get the attention of some people in Washington.
Jay Bryson, thank you so much. Wells Fargo today. I don't know where the fiscal response is. Have you seen it?
Not yet.
It's out there somewhere.
At least they're talking about it, which is an improvement on 2 weeks ago or so.
There was a report about some members of the Treasury Department, Federal Reserve, and Trump's cabinet discussing and putting together some sort of plan. President Trump has not signed off on it. They have not presented it to President Trump, but there is some sort of work on what could be done at this point.
Well, we will see. With the news in New York City, here's John Tucker.
All right, Tom. Mayor Bill de Blasio says New Yorkers should avoid the subway at rush hours, cycle or walk to work, or stay home and telecommute. New York City has 13 confirmed cases of coronavirus. The state has 105. Columbia University suspended classes today and tomorrow. Hofstra canceled classes, and all Scarsdale schools were closed through March 18th. Senator Ted Cruz and Congressman Paul Gosar will self-quarantine after attending a conference with someone who tested positive. The number of cases in Seattle and its suburbs have jumped to 83, and 2 additional people died there. The number of confirmed coronavirus cases in Spain almost doubled overnight, with acute concentrations in the capital, Madrid. The number of cases jumped to 999 today from 589 on Sunday. Dr. Anthony Fauci, head of the Institute of Allergy and Infectious Diseases, appeared on NBC's Meet the Press and said if you're elderly or infirm, there are a couple of things you simply should not do.
If you're a person with an underlying condition, and you are particularly an elderly person with an underlying condition, you need to think twice about getting on a plane on a long trip. And not only think twice, just don't get on a cruise ship.
Passengers of the Grand Princess cruise ship, where more than 20 passengers and crew on board are confirmed to be infected with COVID-19, will be sent to military bases for their mandatory quarantine. We get details in this report from Bloomberg's Ed Baxter.
The Grand Princess is scheduled to dock in Oakland. The passengers are supposed to get off, leaving the crew of about 1,000 to take the ship itself elsewhere. The captain has given initial information to the 3,500 on board.
If guests don't require acute medical care following health screenings, those who are California residents will go to a federally operated isolation facility within California for testing and isolation.
Plans at last report are still underway, and there's some consternation that local officials haven't been consulted closely enough. There are over 20 people who've tested positive for the virus, and the governor says the offloading could take 2 to 3 days. In San Francisco, I'm Ed Baxter, Bloomberg Daybreak.
Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm John Tucker, and this is Bloomberg. John, Tom, Lisa.
John Tucker, thank you, sir. Equities down hard in the early part of trading. Your ETF, your Spider S&P 500 ETF, negative 7%. From New York, this is Bloomberg.
This is your Bloomberg Real Estate Report. I'm Denise Pellegrini. Record low mortgage rates could end up making homes more expensive for home buyers.
The timing,
depending upon where you sit in the market, is, somewhat perfect in that it's the first week of March and the beginning of the spring home buying season.
Mark Fleming, chief economist at First American, says that's as people rush to take advantage of those low rates.
When you're in a supply-constrained market, as we most clearly are, also quite unprecedented levels of supply constraint, that $25,000 or $30,000 of additional buying power you used to try and outbid your competition to get the home, and it eventually basically just bids prices up. So we do expect house price appreciation to accelerate.
And if you're applying for a mortgage to buy a home or refinance, get ready to wait in line as well. Lenders are reporting a rush of applications. And that's your Bloomberg Real Estate Report. I'm Denise Pellegrini.
25 years ago, NJIT graduate Dick Sweeney co-founded Keurig Green Mountain, a company whose incredible innovations changed the way the world brews a cup of coffee. Today, he lectures widely on business leadership and is a strong advocate for NJIT's work to combine business education with the power of STEM.
NJIT is definitely fostering the innovative thinking for budding entrepreneurs simply because that's the world we live in. NJIT is producing students that have been trained, educated, and given the business acumen to be a contributor to a company. The distinct mission is to develop great STEM scholars. The attributes I've always looked for in team members are heart, smarts, guts, and luck. So we want people with passion, intelligence, courage, and never discount luck. The student coming out of NJIT has experienced all of that.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
Delayed at the dentist and now you're late for school pickup. You need a free now. Need to take the dog to the vet before lunch. Should have gotten a free now. Trying to get 4 kids and their baggage to the airport. Free now. Sometimes you can't get from A to B fast enough. Download the Free Now app today for quick pickups and reliable drivers, no matter the situation. Less hassle, more hustle with Free Now.
Hey, have you heard? The Mayor of London has launched his latest van scrappage scheme to help tackle London's toxic air. Small businesses or sole traders like me with a polluting van could now get £7,000, which you could use to trade up to a Euro 6 vehicle. And you could get an extra £2,500 towards running costs if you go electric. The scheme is now even easier to qualify for, and it's open to any businesses with up to 50 employees, like mine. So, I'm going to search TfL Scrappage to see if I'm eligible and apply. You should do the same. To the Mayor of London and TfL, every journey matters.
At Asda, with our great range of beers and cider, it looks like you're hosting. Get 2 packs for just £18 or just £10 each. Like 12 bottles of Corona or 10 cans of Copperberg Cherry. Cracking brands, refreshing prices. Don't compromise. Asda. Save money. Live better. Selected stores subject to availability. Offer ends 18th of March. 330 millilitres each. Drink aware.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
And I'm Karen Moscow. Oil prices are plummeting this morning. Equities plunging and Treasury prices are soaring as the world heads for a full-blown price war in crude, and panic appears to grip financial markets. S&P futures, they fell about 5%, triggering trading curbs this morning. The whole U.S. yield curve fell below 1% for the first time in history. And we check the markets every 15 minutes throughout the trading day on Bloomberg. S&P futures are down 145 points right now. Dow futures down 1,255. NASDAQ futures down 410. The DAX in Germany is down 7.3%. CAC in Paris down 7.6%. And the FTSE 100 is down 7.1%. 10-year Treasury up 3 8/32. The yield 0.43%. Yield on the 2-year 0.26%. And the 30-year yield 0.86%. NYMEX crude oil is down more than 23%, down $9.61 at $31.70 a barrel. COMEX gold up 1/3 of a percent, up $5.70 at $16.78.10 an ounce. The euro 1.1420 against the dollar. British pound 1.3118, and the yen is at 102.86. 2.26. And that's a Bloomberg Business Flash. Tom and Lisa.
Thank you so much, Karen. We are looking at a historic day in markets as we see bond yields tumble to new all-time lows, falling some of the biggest gaps lower in yield, price higher ever in history. Meanwhile, people trying to figure out what the historical precedent really is. Marcus Ashworth has lived through a number of historic periods, including 2008 when he was working over at Mitsubishi UFJ. And Marcus Ashworth, currently a Bloomberg Opinion columnist, can you give us a sense of perspective before we get into the market action of what this day kind of feels like to you relative to, say, 2008, 2011, 2015, 2016?
Well, they are completely different. This is a consumer crisis in the context that it's not a banking crisis like 2008 was. So I felt a lot more scared then than I do now. Though clearly the way the markets are trading, this is in some senses unprecedented. Credit spreads are blown out more than it did on Lehman, certainly in Europe anyway. So, but this is a stupid mistake done in oil, which has created a further leg down in this, which was starting to look like we might have at least found some balance. So I'm not weirdly that worried, because one, there's nothing we can do about this because this is a virus, and two, I'm seeing some signs the cavalry are, they've been in the post for the last week or two, but hopefully they might arrive on the doorstep, and there's some noises coming out of various places, both from the Fed, both from European governments, and indeed from the EU and ECB, that something's going to get done fairly soon. So there are signs that we know what to do, or put them more importantly, there are different things that can be done, but at least there are people who are aware of that now. So yeah, it's bewildering. It is definitely different. You can't really compare it to previous crisis because it's different.
Marcus, let's unpack some of what you were talking about. You're saying it was consumer-led crisis, given the fact that people perhaps are not going to be earning income because they'll be staying home due to coronavirus concerns. On the flip side, there also are clear financial market stresses that are being felt on a day like today as the moves come so fast and furious. And I'm wondering, from your perspective, can you speak to those financial market stressors? I mean, how orderly is the selling that we're seeing today?
It's not orderly at all. In fact, there is no market. And that's basically the problem caused by overregulation, perhaps you could argue. And that's something which one of the solutions to this is there needs to be a little more intelligence put towards different types of restrictions on what banks and marketplaces can do and how they act. So, I mean, that's the trouble. This is made worse by the fact there is not a deep pocket of proprietary trading or indeed banks that are prepared to step in here. Normally they would be able to, or previously have been able to. So, I mean, that said, there are mitigating factors here. As I said, I think we've seen the template of what can be done before in times of crisis, and all we require is our politicians and the G7, etc., to get their act together. And there are some signs they might be doing that.
Marcus, do you have a belief that floating foreign exchange rates compensate the system and that they can provide some relief to these shocks across many, many different currency pairs?
Certainly they do, and I think that's the one good thing we have. We have a liquid and active foreign exchange market which can take stresses where it needs to be. I look likewise in oil in some senses. This is a price discovery to the bottom, and look, Saudi and Russia must look at themselves for that, their own problem. But I worry here about the euro because it's on so strong. I worry again about the yen. But dollar weakness is pretty much a good thing for a lot of the rest of the world. Oil producing countries outside, and they're on their own there. But there are some mitigating things here. For every loser, and there are big losers here. They're not necessarily many winners, but there are some.
Right now, I'm looking over in just in the credit space. We're seeing energy junk bonds in the U.S. absolutely crater. Some of the moves that we're seeing, 35, 36 cents in the dollar. I'm looking at the trace. Yeah, well, I'm looking at the trace screen. They're basically, this is the bond pricing screen from FINRA, and you just see, I mean, absolute gaps out. And I'm wondering, at what point are you hearing people start to step in, or is this basically a falling knife? Are you basically just seeing a removal of any type of buying?
There's definitely that, but I mean, look at what happened last time. We have seen this particular movie before with shale, and the local banks and did not let a vast range of bankruptcies go. They held up the system, and indeed the banking system is even stronger now than it was then. So I don't see a mass collapse and bankruptcies of wholesale because it doesn't suit anyone's benefit. At the same time, a lot of the shale producers are hedged. It's their model. They will shut off. There is at least a year's breathing space before we get ourselves into a really serious problem. We've seen, ironically, Russia say something similar. They can hang on down here for up to 6 years, they say. That may be exaggerating it, but this is not an instant bankruptcy collapse thing. Now, a lot of these spreads were already very wide, and they've gone a bit further today because there is literally no bid. But I don't see this as quite as catastrophic as it might have been to last time around.
Marcus Ashworth, on all of us at Team Surveillance, thank you so much for our repeated visits through the recent days. Marcus Ashworth, writing off our London desk for Bloomberg Opinion. There is a headline which many, particularly here, good morning to Washington, New York, and Boston as well, of people walking away from the view of the first quarter. JetBlue withdraws first quarter fiscal year guidance on virus uncertainty. That's something I would suggest, Lisa, we're going to see a little bit of.
Well, yeah, and Tom, to the airline story, I was just talking about individual bonds. American airline bonds absolutely tumbling now, tumbling from more than 100 cents on the dollar to 84 cents on the dollar, the last trade in 3 trading sessions. Yeah. And this just goes to the question of how long can they sort of withstand the fact that people aren't traveling?
Well, this goes back to, talking to Gina Martin Adams about the elasticity of these corporations. By that, I mean the malleability, their ability to make choices, make decisions. Do you stop flying airplanes? What do you do with your labor force, particularly valued, high-skilled employees at every pay grade?
Well, George Ferguson over at Bloomberg Intelligence saying
He's wonderful.
That for the most part, the large airline companies have enough liquidity to go until May. And then... So that's there are questions.
To your point, we're here, folks, I believe in early March, and we're just beginning to frame getting to April. And as you say, getting to May seems in the off distance as well. Much more to talk of, including getting the market open. We'll do that in 33 minutes. This is Bloomberg.
Asset managers who seize change to launch new strategies, add distribution channels, or exploit new technology to re-engineer the investor experience are often rewarded. However, in an industry paralyzed with complexity, few act with agility or decisively. Few run their businesses strategically, yet the most competitive managers in the market know with the right partner and a flexible operating system, you can. Go boldly toward change with SEI Investment Manager Services.
Determination and operational strength are both essential factors for growth in asset management. I'm Steve Meyer, President and Head of SEI's Investment Manager Services Division. We know that disruptive forces create opportunities around the world. If you see potential in change, our industry specialists will maximize SEI's integrated platform of data and risk management, global investment operations, compliance support, and investor services to position your asset management business for success. Come grow with us.
With SEI Investment Manager Services, you lead the charge in a competitive marketplace. Learn more at SEIC.com/seize change.
Business is constantly evolving. Is your financial printer evolving to keep ahead of the curve? At Command Financial, we are redefining financial printing by providing industry-leading expertise, leveraging technology, and honing processes and best practices. Every day, Command helps SEC registrants, as well as members of their working groups, including securities attorneys and investment bankers, prepare, file, and disseminate regulatory and disclosure documents, such as registration statements, M&A documents, and mutual fund prospectuses and reports. Command provides a full range of services to help you effectively complete your deal, meet your disclosure requirements, and achieve your shareholder communications objectives. Visit our website at commandfinancial.com and learn how we're evolving, not only with the times, but also with your business requirements. Command Financial, redefining financial printing.
This is a Bloomberg Money Minute. Wall Street's headed for an ugly day. We've got oil prices cratering, and the stock futures fell as much as they could before trading curbs kicked in. The U.S. futures down almost 5%. NYMEX crude lower by 24% today at $31.40 a barrel after Saudi Arabia and Russia launched an all-out price war. Possible we could also see some trading curbs in regular trading today on Wall Street. The New York Stock Exchange rules pause trading at a 7 7% drop in the S&P 500. Investors were already on edge over fears surrounding the coronavirus outbreak. The Trump administration is drafting measures to blunt the economic fallout from the coronavirus and help to slow its spread in the U.S. This could include a temporary expansion of paid sick leave and possible help for companies that are facing disruption from the outbreak. That's according to 3 people familiar with what's going on. Gina Cervetti, Bloomberg Radio.
Our relationship with Asia is simple. Find the most experienced journalists.
These countries will need each other more and more in the future.
Let them gather the best data and experts.
Let's get to Singapore now and our guest.
Then bring everything they find straight to you.
Let's talk about where you are. There's quite a lot of headwinds there too.
Actually, it's not simple. It's just better. Bloomberg Daybreak Asia, tonight at 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening. We have to get it right the first time.
We always talk about the losers in a trade war.
You benefit if you're just further away from China.
So that you can too.
What are the ramifications if she crumbles or doesn't crumble?
Bloomberg Radio, the Bloomberg Business, Radio.com, and iHeartRadio apps, and BloombergRadio.com. Bloomberg, the world is listening. From the financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. This is Bloomberg Surveillance Economics.
I think the U.S. is going in for a couple of years of very, very strong growth.
The deficit by early in the next decade will start to become a real problem for the markets.
Finance.
The consumer is really strong right now.
We don't realize how good times are now.
Investment.
The biggest problem that people have in investing in stocks is that they get out of the market.
It's not supposed to be easy. Anyone who finds it easy is stupid.
Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
Good morning, everyone. Paul Sweeney and Tom Keene. Chris Rupke there. We don't realize how good times are right now. Chris Rupke out with a very smart note last night. Maybe it was early this morning, looking at the bond market. Dad, Paul, you've been doing this for years. What's the greatest distortion you see on the Bloomberg screen on this historic morning?
You know, it's just extraordinary, Tom, as you've been talking about all morning. But, you know, it just that the first time ever to have the yield curve below 1%. We're in a whole new world here. I think a lot of investors never thought we would get here. We've been looking at Germany. We've been looking at Japan, even Switzerland with negative rates. Never thought we'd see a yield curve look like this. And, of course, what does that mean for the U.S. and global economies?
And it's global as well. We'll get to Mr. Sassar here in a moment. German 2-year yield down to new record lows, negative 0.980. I guess we'll get a 1% figure on that. Swissies in, and, you know, the Brazilian real. We'll talk about currency markets moving as well. Futures a negative 145, but David Wilson's going to explain to us right now why that's not an accurate statistic. It hasn't moved since 10 o'clock last night.
Well, that's what happens when trading freezes up, and certainly we've seen a fair amount of that internationally and here in the U.S. in response to what's happening in the energy markets.
Limit down. Come on, he's being bashful, folks. David wrote a fantastic book. Good beach reading, I should point out. He was going to title it Limit Down, but they didn't go with it. And what was the name of your book?
The Visual Guide to Financial Markets.
There it is. Okay. What does it say about limit down? I mean, these are rules they have in place. Why do they have rules to shut down futures?
Well, the whole idea is to kind of give people a reason to step back and maybe think about what they're doing so you don't end up with a catastrophe. I mean, that's as much as anything what's happening. And don't forget, there are circuit breakers, as they call them, in stocks. And we haven't seen them tripped in a long time. 1997 was one example of when that happened. But it's the sort of thing you pay attention to on a day like today, if nothing else. I'll tell you, though. You're asked what's the biggest distortion? I'll give you one.
What are you open with?
If you look at U.S. energy stocks as a group, there are 32 of them right now that are down more than 30%.
30%.
Yes.
I'll bet in your grizzled past you've never seen a day like this. How do you start your data check today? Let's go
with ExxonMobil because, shares are down 15% in early trading. Of course, it's all about the breakup of OPEC's alliance with Russia and how oil prices are tumbling. But just to put today into context, I went back and looked to 1980. Biggest drop in Exxon shares in a day over that period, 7.4% in October 1997. So what we're looking at today is potentially twice the biggest decline we've seen in the past 4 decades in Exxon, and that drop is relatively small when you look at some of the other producers.
I tear up here over Wilson Scope and Scale. I mean, we'll never get that from Damian Sassower.
No, we will not.
It's a rare treat. Sassower's over here taking notes. Next stock?
Well, let's just take a look at some of the other oil majors, if you will. Chevron down 16.5%, ConocoPhillips down 24%, Occidental Petroleum, let's not forget, got that investment from Warren Buffett's Berkshire Hathaway last year when it bought Anadarko Petroleum. It's down 38.5%. Yeah, and it's not just the U.S. oil companies either. You look at the American Depository receipts of the international oil producers. You see BP down 19.5%. You see Royal Dutch Shell down 13%. France's Total down 12%, and Brazil's Petrobras lower by 19%. And of course, it's not just the producers, it's also the service companies. Halliburton down 30%, Schlumberger down 27%. You know one group that's actually moving up, though? The companies that own oil tankers. And it's all about the prospect that more crude oil will be stored offshore.
That famous Bloomberg Business Week cover of all the boats in the Straits of Malacca, is it?
Wherever they may be, there may well be more of them. We got a text from Frontline CEO Robert McLeod, and it said oil traders and major producers are requesting offers for storage. Wow. So you've got Frontline up 3.5%. Nordic American Tankers up 2% in early trading. Yeah, it's kind of hard to find stocks that are up. You know, let's face it, in another set of circumstances, plunging oil prices would be a plus for the airlines.
Couple more.
But it's not.
Sassower's agent just called and said, let's go. A couple more.
Americans down 6%. Delta's down 5.5%. Southwest is down 6.5%. United down 6%. Of course, we're also seeing the cruise line owners fall as well, thanks to the State Department advising Americans to avoid travel on cruise ships. Carnival, at the moment, down 10.5%. And the biggest financial companies, Bank of America, Citigroup, JP Morgan Chase, Wells Fargo, all down 10% or more as those treasury yields plunge.
Seriously, through the morning, David Wilson, and of course, when the market opens up here, we'll get a much better handle on those futures limit down right now. And I want to make clear there's rules for when we open about how that can occur as well. Right now, SPX futures, rather the ETF showing me down about 6+%. Why don't you bring in Damian Sassower?
Yeah, Damian Sassower, he covers all things emerging markets for Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker studio. So, Damian, I know you're working over the weekend on a note trying to put kind of emerging markets, that far end of the risk curve, kind of in context for investors. You wake up today to this, and as somebody who looks at emerging markets, currencies, and all that, what do you make of what is looking like going to be a historic day today?
Well, full disclosure, Paul, two things. First of all, I tried to find anything that I could find on Friday that would carry over into Monday, and it was hard pressed to do it. And we weren't sleeping over the weekend because if you saw, obviously, what was going on in the Middle East, and I'm not going to talk about individual oil stocks. I'm going to talk about 12-month forwards in Saudi Riyal and Omani Riyal. The pegs are at risk here. You know, these countries peg their currencies to the U.S. dollar, and when you see forwards blow out the way you have to kind of question whether or not they're going to be able to defend it, right?
Well, so what does that mean when relative to the peg?
So basically, most Middle East countries peg their domestic currencies to the dollar. Why? Because oil's denominated in dollars, and that's their biggest export, right? So with oil's going parabolic here, and you're just seeing the front ends of a lot of these curves follow, and I think you're going to see a lot of emerging market countries aggressively defend their currencies because the depreciation is extreme. I mean, I've heard Tom talk about the Brazilian real for the better part of the last week, and go figure, now we're at 475. Right. Mex peso, 21 handle. I think at one point the rand broke above 17 overnight. I think it came back, but I mean, these are huge, huge moves in emerging market currencies, and believe me, these governments are not going to sit idly by and let their currencies depreciate like that.
Give us a sense of kind of how well they can defend their currencies. I mean, do they have the wherewithal to do that?
Not very. No, I know. I mean, look, they do have reserves. They have ample reserves. They're certainly in a better position today than they have been in recent years. But, with growth coming out of bed, and if you just look at what the U.S. Treasury curve is telling you today, the entire move in Treasuries was all driven by inflation break-evens. It's all inflation expectations. It's basically, this is because oil prices are coming down. This is not growth. This is not real yields. These are inflation expectations that are falling off of a cliff here.
We've been talking about this all morning. Explain the the imputed disinflation or deflation, and what that means to emerging market governments?
So what it means is that it's going to be a tale of two stories. It's going to be commodity importers and commodity exporters, right? So if you look at commodity exports, Colombia and Malaysia stand out to me. They're oil exporters. The price of oil is coming off, and those countries, despite the fact that they are, they have the idiosyncratic issues, the currencies are going to reflect that. On the flip side, you have countries like India, who are big oil importers, who might well be benefiting from this, right? I mean, you look at the U.S. consumer. Gina Martin Adams been saying it all morning. Falling oil prices is like falling taxes on your income, right? So it's similar for some countries like India.
I mean, people don't know, folks, Sassower has his own corner here in the skyscraper. He's so large. And it's like hermetically sealed, like there's no coronavirus. It's like cleaned and sanitized every day to an absolute perfection. There's no desk in the 19,000 employees that clean. And so when you look, Damien, at your sterile work environment, all it comes down to is how do you synthesize or summarize the disinflation that's coming? How do you frame that across the 87 things you're looking at once?
Tom, as you push closer to zero, and I'm talking zero yields, zero growth, zero inflation, there's no asymmetry left in markets. It truly is a zero-sum game. There's winners and there's losers. There's no in between, right? With no carry in the market, there's no asymmetry. So you better get used to the eye of the bell curve we're sitting in here. I wonder what the weather's like. We're getting our first glimpse of it right here. And for me, I mean, I might start carrying a knife to work, Tom. There are going to be people knifing each other in the subway trying to get carry out of this market.
Yeah, maybe. Let's look at Brazilian real, 4.74. To review this, folks, 4.00 was a huge deal. That was a weaker real, 3.80, 3.90, 4.0. We've exploded out. Describe the instability to the Brazilian financial system of that sharply weaker real, just as one model.
Well, I think you got to look at iron ore prices. You got to look at a company like Vale, a low-cost producer, but with obviously what's been going on with China-U.S. trade, then the coronavirus, it's iron ore exports. They've just been falling off a cliff. So I think in large part, what you've seeing here is, I don't want to call it the government allowing the currency to depreciate, but yeah, I think they were doing that because they had to reduce the price of their exports to try and make it more competitive on the open market. So, but I think we're done with that because just this morning, Brazil's announced they're going to be doing 3 times the amount of FX swap operations. They do that to kind of sterilize their currency.
Translate that.
Basically, what the government does is it tries to sterilize its currency domestically, and what it does is it basically engages in the U.S. dollar, Brazilian real swap market to kind of do that and sort of manage the volatility around that currency cross. Well, they haven't been doing that for the better part of the last few months. Today, they are aggressively doing that, and I think you're going to again see more emerging market nations aggressively try to defend their currencies and do whatever they can with whatever ammunition that's left to them, Tom.
Damien Sassower, thank you so much for running all of our EM research and process as well. Paul?
Yeah, let's get some context on what we're likely to see today, Tom. Arthur Levitt, former chairman of the Securities and Exchange Commission, has as much context and perspective as anybody.
Panic of 07.
Absolutely, he was there. Arthur, give us a sense of kind of how you think the SEC is looking at today's market action.
Well, I think this is a serious matter for them in terms of what they do. And if you take a look at the order of providing conditional relief, you see that kicking in, that it exempts registrants from the requirements of the Exchange Act and the rules to furnish proxy statements, annual reports, and other materials. I think that it also requires companies to assess the impact that COVID-19 might have on upcoming annual meetings. It seems like a small matter, but it's extremely important. So I think the Commission is ahead of the curve on this, working with reports to audit committees and auditors to ensure that financial reporting is as robust as practical in the light of what's going on.
Right. So, Arthur, you've been in this market game a long time. Give us a sense of kind of what we're seeing here this morning, what we've seen over the last couple of weeks. Does this feel like panic to you? What are you hearing from some of the folks you chat with?
No, I don't think it feels like panic. It feels like an extraordinary event which requires extraordinary solutions, but it's by no means a panic event. I don't think the markets are going to react to this, obviously, but this is not a panic event. The system is robust, able to handle all transactions. You're not going to see any calls for a halt in trading or other draconian measures of that sort.
Arthur Levitt, thanks so much for joining us. We always appreciate your perspective here. Arthur Levitt, former chairman of the Securities and Exchange Commission and, of course, a board member of Bloomberg LP. Tom, I think it's really important to get a sense of kind of where the consumer might be given all this market turmoil. And there's absolutely nobody who I think has their finger on the pulse of the consumer than Dana Telsley. Dana is the Dana Telsley Advisory Group CEO and Chief Research Officer. She's been covering retail forever, really the best out there on the street for retail. So, Dana, we're in uncharted territory, it feels like, here today and really over the last couple of weeks. And, you know, that calls into play and calls into question the strength of the consumer, because let's face it, it's been the consumer that's been pushing this U.S. economy along. What are your thoughts as you wake up to the volatility that we're going to experience here today?
I think we're going to continue to see extreme volatility, and basically with consumer spending holding up the economy. And if there's any weakness in consumer confidence, that is just a making 2020 almost like a year to forget instead of remember. Yes, will we have a recovery? Of course we will. But in terms of getting from here to there, what's working is certainly household essentials. And you heard it from Costco, you heard it from Target, and certainly Amazon will be a winner in this. Discretionary is going to be having its impact because of the weakness in traffic. Certainly what we've seen is new human interaction in a way of everyone's learning new words, whether it's social distancing, whether it is isolating or quarantining. The ability not to be part of large groups is something that people are valuing. And I think that this goes on for a period of time until there is a stem to the implications and, frankly, the positive testing of those for coronavirus.
Dana, let's go down the food chain here and start with luxury. I noticed the streets of New York this weekend were a lot more empty than I believe I've ever seen them on a pleasant Sunday afternoon. Dana, what does luxury do here? What do they do up Madison Avenue, up Bond Street in London? What do they do over in Europe? I mean, do they consolidate? Do they go out of business? Does everybody end up being owned by one of the three companies? What happens?
It certainly seems like there easily could be more consolidation. Look at the news we got this morning from Swatch, who said that there's a massive impact given the hundreds of store closures in China that they've had. China is certainly, and the Chinese consumer is something that these luxury retailers depend on globally. So you continue to have a downturn in the luxury stocks, certainly for the first half of 2020 at least. Earnings estimates and sales estimates will be revised downward. The implications of the strength of the brand, I don't think that goes away in the near term. I think that holds, but the ability to buy is something that people pull back on.
Well, okay, then go to the larger department stores, Nordstrom and the likes of that, the well-heeled department stores. How do they do here? Are they flush with inventory? They've got to move out at 90% down?
You're going to get great deals on some of the inventory out there. Keep in mind that a lot of these companies, given what was happening with Chinese New Year and then afterwards with tariffs, a lot of them were watching their inventory levels very carefully to begin with. But it's going to make the spring season definitely more tempered than what you would have expected it to be. And I believe that we haven't even begun to see what the traffic patterns have been. A lot of companies just reported fourth quarter right before the outbreak of coronavirus. So you're going to get, I think, revisions downward to guidance that comes with their May earnings conference calls.
So, Dana, could this be the final nail in the coffin of the, average shopping mall across America? That seems like a lot of the malls outside of the very top tier, obviously have been struggling. Could this kind of push some over the edge, do you think?
It takes a long time to kill a retailer. It takes a long time to kill a shopping center. We certainly have been seeing some vacancies. Most of those companies and the announcements of store closures have already been announced. I think the landlords overall are going to have to think of events to drive traffic and, frankly, to drive interest at a time when people don't want to be together. People are ordering from their homes more today than I think they were 3 or 4 months ago. And this time will pass.
And so ordering from home, how much do you think the e-commerce aspect of retail will cushion the blow for some, let's just say, the department stores of the world, or even just come to the more general merchandise?
I think overall e-commerce certainly helps, but I think the focus on what people are buying, you can call it hoarding, you can call it household essentials, but they're buying what they need. Wants come later. I think when you have kids' schools being closed, when you have athletic events being delayed, conferences being rescheduled, travel slowing, the here and now is, what do we need to do to keep our families healthy?
Dana Telsey with us, Telsey Advisor Group. We continue with Ms. Telsey, and we're thrilled to say she's one of the 100 most influential women on Bloomberg surveillance each and every day. She just has wonderful acclaim
from
and
Barron's,
earned acclaim from Barron's as well. 100 most influential women in United States finance as well. Dana, so the lower interest rates, does that help debt encumbered private equity that owns all the retail stuff? I mean, all these people that basically bought at the top, that was a low coupon. Can they refi on the way down?
Something I think they're all going to be taking a look at. I think we'll see things like that. You have companies. Look what we've had companies. Some continue to announce IPOs, and you'll see some of that where it's essentials. I think everyone's taking a relook, and that's why I think you see a valuation reset after we see some stabilization.
So, Dana, I know you and your team at Telsey Advisory look across the retail spectrum and across the consumer spectrum. As you think about retail, what are some of the areas or subsectors that you're most concerned about, to the extent that this coronavirus maybe goes a little bit longer and has a maybe more impact on the economy?
It's apparel retailing. It can be luxury goods. It can be home furnishings. Those are some of the areas that we're watching the most because they're the most discretionary.
And so, again, when your company's reported earnings, it was really before the coronavirus. If you're going to get pre-announcements, when do you typically get them from the companies that you cover in the retail space?
You'll typically get them sometime mid to end of April. But keep in mind, companies haven't finished reporting the fourth quarter yet. Think about what's happening this week. We have a ton of companies reporting. Dick's Sporting Goods, for example, is reporting on Tuesday. Stitch Fix is reporting after the close tonight, as is Ascena. We have Express on Wednesday morning, along with Vera Bradley. And then when you think about Thursday, Ulta and Gap are reporting their numbers, along with some of the party cities of the world, and Genesco and Dollar General. So we're going to get a current, up-to-date view this week, given you have around 13 retailers reporting.
That's going to be interesting, yes.
Exactly.
Dana, thank you so much. Dana Telsey with Telsey Advisory Group. Thrilled that she could be with us today. Futures negative 145, which means nothing.
Yep.
Because we are limit down. They've been flat since about 10 p.m. Last night. We're using the equity ETF, the SPY. This is the proxy for the Standard & Poor's 500. I'm bringing it up right now, Paul. I should have had that up.
We're on lows of
earlier.
the day, Tom, down about 7.3%. I know you and John have been following it all morning and, kind of testing new lows in that SPY ETF.
Yeah, they're churning. A 30-year bond was lower yield, but now 0.89. I really want to say, when we look at the screen here, folks, for those that don't follow this across equities, bonds, currencies, commodities, in each of those categories, it's a whole new world after all.
It really is.
There's no other way to put it.
Absolutely. And, one of that news item across the weekend about Saudi Arabia just kind of ramping up production just pushed, that energy market just into panic mode. And, with crude here down, over 20% here, it just kind of adds to the overall instability that I think a lot of investors have been feeling about the coronavirus. Just another issue to deal with. And so, again, that's really raising concern about the oil patch, certainly.
Can I ask a dumb question?
Absolutely. This is the place to do
it. If people were doing share buybacks at Dow 29,000,
yep.
What, do they double them here? Well, how does that work?
I would think so. I would think obviously, when you hear C-suite folks and CFOs say we're opportunistically in the market. Well, here's an opportunity. And if you feel comfortable with your cash balances, comfortable with your free cash flow, and now that free cash flow generation might be at risk here, but if you're comfortable with your liquidity, these are really the times to put the money to work.
I look at the things that are necessary, and this is a digression. Pharaoh was apoplectic about Juventus and Milan played, I believe, in Milan to an empty stadium as well. I mean, there was trauma.
Yep.
That wasn't the biggest trauma out there. And I don't mean to make light of the virus and the stress in northern Italy as well. If you're fighting for a wild card spot and you go out to the West Coast and you play the three patsy teams of the National Hockey League and you go LLL, that's not a good thing.
That's not.
We thought he'd be out today, not with the virus, but just suffering with the Toronto Maple Leafs. Luke Kawa joins us this morning. I mean, before they went out and did the West Coast swing, that's supposed to be WWW, right?
I mean, but whenever anyone goes on the West Coast swing, they lose, right? Like the Penguins just did that West Coast swing right before the Leafs, and they went 0-3 too. But yeah, if I had to stay at home with a broken ego, I'd be at home every day. So we're in the office again today.
Luke Kawa with us, and he was exceptionally strong over the weekend. Luke, you put out a spectacular chart of the volatility of the 10-year yield, and are you willing to say we're back to Lehman territory?
Oh no, we're above that. It's like the TY VIX, which is it's the same construction methodology as the VIX, so it's actually measuring the volatility of the price and the 10-year note rather than the yield. So you could say just because of base effects, you should be thinking you're getting jumpier as we approach zero. But yeah, that we got as high as essentially 14.75, I believe, this morning. What that means in practical terms is essentially you're betting for the 10-year note to move about 1 percentage point per day, which is just a crazy degree of volatility in bonds expected. So yeah, that's happened.
When you drained the electricity of Manhattan and loaded up the 3 Bloombergs this morning, what did you see on the screen?
Oh, when I loaded up this morning, the main thing that freaked me out and is freaking everyone out is the extent to which how quickly this became credit-centric concern. So last week you had a really odd dichotomy where you had CDX, investment grade and high yield, widening by meaningful amounts, and stocks were still up. The amount of that discrepancy was very, very rare, and the last time we saw anything like it. So
what happened on Monday?
Well, everything exploded. Like right now, if you're looking at high yield or investment grade CDX relative to its 3-month average, we're getting into the Six Sigmas, Tom, which I know your favorites.
Translate this right now, folks. This is the protection of credit default swaps against all of these troubled debt securities, and they're on a trend. And then when they get off the trend, they go out 1 or 2 standard deviations. 3 is normal, 4 is ugly. In the medical business, 6 standard deviations is ugly, and that's the late Jack Welch's 6 Sigma, isn't it?
Yeah, that's
you okay there?
Yeah, I certainly couldn't do it any better. And yeah,
you did better than the Maple Leafs.
This is So this is essentially what we're seeing is a lot of this has to do obviously with energy and energy being a focal point in the high yield universe, but the extent to which this is also in investment grade also really makes you think this is about more generalized credit stress and people kind of all jumping to the same place at once, which makes these products weird is that everyone's loved hedging with IG CDX just because, when everything hits the fan, it has that convexity, it gives a real jump. But what that means though is if this is the one that everyone wants to own, it also is the one that dealers are the most short. So you have the effect of buying this back just to kind of hedge your exposure.
Let me translate this. You own something and you want a protection against it. So you hedge with this fancy pants investment grade security. It's gone bad in the last 24 hours, right?
Well, if you've hedged with this, it's gone good. Your hedge has gone good. The underlying market itself definitely not good. But the hedge is performing in a way I think people would expect it to at a time like this, which there are a lot of things out there that haven't necessarily done that.
Okay. So, Luke, as you look across asset classes here, as the equities kind of limit down, the yield curve below 1% for the first time ever, oil falling out of bed, is it panic in the market right now? Is this different than maybe last week?
Yeah, I'd say the main thing to watch for like your clear sign of panic, and I remember this from when I was talking with Tom on the morning of February 6th, 2018, and I believe we were wondering like, why the heck, this is huge risk off. We just had the biggest one-day jump in volatility on record. Why are short-term treasury yields going up? And Tom said, oh, that's easy. They're being used as a source of funds. Once the treasury market starts to become a source of funds, then that probably means we're in true panic. However, things look, you can't not call this panic, but things can get panickier.
Looking at gold here, a little bit of a bid there. That continues that trajectory. So that's just your traditional flight to quality, Luke?
Yeah, I mean, the flight to quality message is actually something you see very uniformly across markets. If you look at factors in the equity market, what's held up the best? The profitability factor. If you look at a basket of Goldman Sachs stocks that have strong balance sheets relative to the weak ones, that's at its best level since 2012. So this is where people are hiding. It's in yield and it's in quality. And although the energy companies have one in the yield, they don't have the other.
Okay, what we're going to do here is do a data check of the market opening. We're thrilled that Mr. Kawa and his entourage will stay with us through the market opening, and we'll continue this really sophisticated conversation, trying to get convexity into every third-minute discussion as well. Convexity, folks, is when you have to get out. It's the acceleration of the trade going the opposite way. What you need to know right now is many of these safe havens have moved abruptly 45 seconds away from the market open. Gold up $13, $16.86 the ounce, and critically, Japanese yen right now is testing the strength that we saw at 3 a.m. and somewhat near where we were at 11 p.m. last night in the early Asia morning. The yen right now, Paul Sweeney, 101.84.
Yeah, search for, as Luke was just mentioning, search for a safe haven. We see that yen at 101.85. It's interesting here, just looking at crude here, off even 20% here, $32.67 for WTI right here. So clearly that supply-demand issue really weighing on the markets here, given the Saudi news.
This is Bloomberg Radio Worldwide. We welcome you from New York and Bloomberg 1130, Sirius XM Channel 119, Bloomberg 1061 in Boston. Our special coverage today, we are commercial-free, and we thank our sponsors very much for allowing us to do this today. The Dow opens off 1,700 points. There's various limit constraints as well. Paul, I'll pick it up here as you look at the data, but it's something to say we're down 5,000 plus points from where we were not that long ago.
Yeah, 3 weeks ago, Tom, we were talking about daily highs almost every day here. So what's changed here? Well, what's changed is just the outlook for global GDP growth driven by the coronavirus.
It's really picked up as well. The DXY, that blended index, 94.80. The yen 101.92. Rounded up, euro dollar 115, 114.64 itself. We're down 1,700, make it 1,800 points in the Dow, and we'll settle out over the next 15 minutes or so. The levels, Standard & Poor's 500, 2770, 2770, and the Dow 24,035 right now. Our opening bell, always brought to you by SEI. Today's competitive marketplace requires asset managers to become more operationally adept. See how you can transform your business with SEI's global platform at SEIC.com/IMS as well. Brazilian real looking at EM, that's out to new levels, 4.77. Even Turkish lira with all the idiosyncrasies there of the border, and with Syria and Russia, Turkish lira weaker today as well, 6.11. Mexican peso, 21.12. And I'd bring up South African rand, but I can't because my terminal's on fire here. Down 1,800. Paul, I can't remember if I've ever seen a negative 1800 on the Dow.
No, I have not. We're down 7% here across the equity indices right here. Luke, as we look at the opening here, a couple minutes into it, again, equity markets now just kind of opening up here. What do you think of these expectations on the average trading desk out there? Are they saying, hey, we got to step in here and provide some support, or are they just kind of saying this is really outside of all of our models? Let's stay on the sidelines unless, we really have to get in there.
The main thing I've heard from people who I've been talking to over the weekend, because everyone who's been anyone has been in over the weekend gaming out, like, what are vulnerabilities, et cetera, et cetera. That's the main concern. Nobody is trying to get greedy right here. Like, there's that line, when the time comes to buy, you won't want to. That's very much the order of the day right now. Folks are mainly interested in, okay, where's our leverage? Where's our vulnerable positions that are going to be tough to exit? And let's make sure we do that now.
Luke Cowles, can you stay with us for a few more minutes, Luke? I know you've got a pressing date calendar as well. Apple Computer, negative 21. That's a 7.5% move, added up over 3 days, 7, 8, 11. I'm going to call 12% down Apple Computer. How about JP Morgan is another indicator of where we are, down 13%. Plus 9, make it 10 over the last 2 days. So in 3 days, that's 22-ish% on JP Morgan as well. I might as well go with another high flyer. Luke Kawa driving that big machine that he drives. Tesla down 13%, plus 6 makes it 18, 19% over the last 3 days. Some of the indications that we see out there, negative 18.55 on the Dow. Paul, we haven't captured a bid yet on the opening, have we?
No, we really haven't here. Again, we've been sitting down here, Tom, down about 7% here. And again, it's a term that we've used a little bit over the last couple of weeks, and we've heard some of our strategists talk about it, which is price discovery here. There's so many new variables in the marketplace, and we're seeing it on the up and down moves, kind of investors looking for some levels here.
Luke, what have flows been in our institutions flush with cash right now?
That's been a difficult thing to get a handle on. I think, that's Eric Balchunas, our senior ETF strategist, can probably give you a lot better handle on that. I do subscribe to the theory, though, that in general, coming into this, if you just look at kind of notional exposure that you would estimate through your S&P E-minis, kind of the buildup in those contracts, et cetera, NASDAQ too, those are relatively high across the asset management space, and it does suggest, that we were going into this a little happier about risk that we had been in several years.
Luke, you can leave. We have a trading halt. That's the only way, that's the only way Luke Kawa can get out of here. Well, this is a level 1 trading halt. These have been put in place ages ago, and it really is, not to make light about it, but this is for the good of discovering market stability in our indiscoverable pricing, Paul, isn't it? Luke Kawa, thank you.
Yeah, we're going to have a temporary trading halt here, Tom. So give the market, as you said, kind of a sense, get a sense to kind of take a look and assess kind of where we are, take a look at where values are. But that circuit breaker, in effect, the level 1 circuit breaker.
Level 1, and there's level 2 halt trading as well. This is for 15 minutes after 3:25 p.m. Trading is allowed to continue into the close. These were put in any number of years ago. I'm trying to get that data point for you right now. They've been tweaked along the way. And, this is back in 1987, of course, in the crash, and something Arthur Levitt would be more than familiar with. I'm sure he was in those meetings. A level 3 decline is where trading is suspended for the remainder of the day. That would be sort of serious.
Yeah, so again, we're in that trading halt here for 15 minutes. I'm looking at Canadian stocks as well. They were off 7% at the open, and the most since 2008. So this is global.
1885, negative 1885, 23,980, 23,980 on the Dow. Standard & Poor's 2764. That's down 208 Standard & Poor's points, and critically, the VIX hasn't print yet. The VIX is 41.94. Do you see a VIX?
No, I don't. But we have VIX futures. They were up over 50 earlier this morning.
Over 50. So that's I'm going to call that 9 big figures minimum, which sounds about right. We will move down from we'll continue to give you data checks here again with equity market trading halted here down 7%. And we'll have more market guests through the morning. But right now on the American economy, Dana Peterson with Catherine Mann at Citigroup. Dana, what was your economic meeting like this morning? I mean, what was the theme that Catherine Mann set for your Monday morning Citigroup economic call?
Well, certainly the coronavirus and whether or not there should be further downgrades is on everyone's mind. and what those downgrades should look like, and definitely what the Fed's going to do about this. Our U.S. economists have the Fed going, pretty much to the zero lower bound. They have a 50 basis point cut for the March meeting, another 25 basis points in April, and then a further 25 basis points in June. And they've already downgraded their growth forecast for this year from 2% to 1.9%.
Neil Dutta, who's a great optimist at Renaissance Macro, Dana Peterson, says the Secretary of Treasury needs to send out a letter now. What is the action plan Citigroup sees for any beleaguered central bank? And let's start with Washington. What's their to-do list on a Monday morning in a level 1 trading halt?
Well, I remember you asked someone earlier on television whether or not the Fed should go today, and it's not clear that that's necessarily going to happen. But certainly the Fed's going to be watching financial conditions. We saw that they tightened up last week, ending the week still partially in easy territory, but we could see further tightening, and that might really spook the Fed ahead of this March meeting.
So, Tom, I just wanted to summarize here. We're in that 15-minute trading halt right now. The index is down 7%. That started at 9:34. When trading resumes, another 15-minute pause will happen if losses reach 13%. And if that decline hits 20%, markets will close for the day. So so we're starting in that direction right now. So it's just it's unprecedented. So, Dana, what's the sense here? What we know so far on global growth? We've had obviously Northern Italy and perhaps greater Europe having to deal with this as well. How are you thinking about it from a global growth perspective, or is it just too early?
No, we've already been thinking about this. I think the key word is downgrade. We cut our forecast back in February by 0.2, right? So now we're at 2.5% global growth, which is technically a global growth recession. However, that did not incorporate any changes from Latin America. It didn't incorporate the worsening in conditions for Italy and then the spread to nearly 100 countries. So I would imagine that we're going to continue to see downgrades in that global growth forecast.
So how do you, in reality, given all the unknowns that we just don't know yet, how would you expect some of the leading countries around the world from a fiscal stimulus perspective to try to address this issue?
Sure. I think, first on, getting money on the ground in terms of supporting healthcare systems. Some countries are better prepared than others. And even in terms of a coordinated response, the U.S. certainly has the infrastructure, but do we have the coordinated response mechanisms to make sure that every state and locality is addressing things? And then there's also relief, right? So I know in New York, there's definitely going to be relief for small businesses. Businesses with at least 100 people will have access to loans, and really tiny businesses with 5 or fewer people will actually be given grants. So something like that could potentially, we should think about that on a grander scale nationally, but again, it's the coordination.
Dana, thank you so much. Dana Peterson with us with Citigroup this morning. We greatly appreciate her time throughout this morning as well. Paul, help me here with the level 1, 2, 3s. Right now, folks, we are 9 minutes away, 8 minutes away from the restart of markets, and this is a level 1 stop of 15 minutes down to 1885. And then, Paul, level 2 is what? More of a longer stop?
Yeah, it's going to be another 15-minute pause if the S&P declines by a total of 13%. And again, we're down
total
7%.
Of 13 from the opening. So we've gone down 7 now.
Yep.
So another roughly 6%.
Right. So in 8 minutes, we'll reopen, see how the trading goes. If it doesn't stabilize, if it drops even further, again, down 13%. That would put the S&P at about 2585, Tom, on the S&P. We're at 2764 right now. So, a couple hundred points there plus. So if we get there, and then the next stop, the level 3 would be if the market at any time hits a decline of 20%, that would put us at 2378 on the S&P. Markets will close for the day.
Yeah, well, it will be interesting to say the least. We are without commercial for you in this special coverage of Bloomberg Surveillance. We welcome all of you coast to coast, particularly those of you working at home. Any number of ways for you to avail of our home effort. We have been thunderstruck about this has been picked up on our digital product, Paul. I have the clearest memory of the first time I had any understanding of the reach of digital. I got an email, lovely informed, broken English email from a 15-year-old in Vietnam.
Yep.
And this was years ago, Bloomberg on the economy, and I was like, oh, There's a lot of O out there in the digital product, whether SiriusXM Channel 119, Bloomberg.com, iHeartRadio, and the many other ways to get a hold of us on digital. We're just thrilled to invest in that over the years. Shall we bring in Cameron Kreis? He's probably got, buy tickets in right now.
Cameron Kreis, Bloomberg News. He covers all things markets for us. Tons of experience on the street. So, Cameron, thanks so much for joining us on the phone here. What do you make here of these first 12 minutes of trading here this morning?
Well, it's scary. I mean, what can you say? Old veteran. I guess you can't say old veteran market professionals like the three of us have often grumbled that these kids these days have never seen anything like a crisis. Well, I think we have to quit saying that now, because this, in some ways, this is worse than anything we've seen, at least in terms of the pricing of the Treasury market, which is probably, people like to focus on the stock market, but to me, the Treasury market is the scariest thing, because it's essentially pricing a nuclear winter for U.S. markets that will never end.
So again, let's try to put into context here, because this is the first time ever type of discussion that we've had the U.S. yield curve all below 1%.
Oh, wait, I was there in the 30s.
Exactly. So Cameron, again, a grizzled veteran like yourself, what does that tell you?
Well, it tells you that the Fed is going to cut rates to zero and basically never bring them back. If you look at the OIS market, swap market, which is a product that allows you to bet basically exactly on what the Fed funds rate is going to be, it suggests that the average daily observation of the Fed's funds rate is going to be a little over 30 basis points for the next 3 decades.
Okay, but
so basically, that says they're cutting to zero and they ain't never coming back.
Okay, and you and I know, Cameron, expect the unexpected. There'll be exogenous and endogenous shocks that will upset the never coming back apple cart, which is a hazardous thing to anybody's health. How would you presume the market will clear from a point of never coming back?
Well, yeah, I mean, I think we have to acknowledge that this pricing is not necessarily rational.
Thank you.
People aren't pricing this because that's what they think the outcome is. They're pricing it because
it's a parlor game.
in a hurricane, in a maelstrom, in a cyclone, you go to the safest harbor you can find. That is fixed income.
Paul, what Cameron Kreis just said there is absolutely crucial. And that so much of this modern thing, and, I'm looking out here right now, folks, at the acclaimed Bloomberg Museum. I'm over on the left of it, like 1922 or whatever. But the reality to this, Paul, is we're pricing a parlor game instead of the fundamentals. And as Cameron says, we're pricing in forever this belief. Guess what? Forever changes.
Forever changes.
The Disney movies taught me that.
Cameron, one of the questions I've been asking fairly consistently this morning is just looking at the market action over the last week, 10 days, and then particularly kind of over the weekend and this morning. Does this feel like across asset classes a panic phase, or does this feel somewhat orderly in your perspective?
Well, it quit being orderly probably on Friday with the Treasury move, and now it's pretty clearly some sort of panic. If I were to hazard a guess about the future, I would suggest that yesterday will go down as some sort of Black Sunday for the energy market, and the as the consequences ripple through other assets, whether you're talking about the Treasury market, whether you're talking about the credit market, which is really an issue here, because to date, credit has been relatively well behaved relative to say, the stock market. But obviously in the high yield market, there's a lot of energy names. And guess what? They've just been getting eviscerated. FX carry, you see it in the yen, you see it in the euro. The funding currencies are absolutely ripping. Mexico, Mex yen was a kind of a popular carry trade. It's down about 10% today. I mean, that's not what you get when things are orderly and when people are keeping their head.
Let's leave it there. Now I've got that chart up here, folks. I'll try to work it up. JPY MXN. Only Cameron Christ would bring that up. Thank you, Cameron. Absolutely brilliant. Shonali Bassick wouldn't know yen peso if it hit her over the head, but she's here now with what really matters, which is the job economy of global Wall Street. Shonali, you've never seen anything like this. The only equivalency I have is 1998, which was really in its own way strange and ugly, different than this. What's it mean for job prospects, not only in in New York rather, but also in the city in London?
Listen, today's a very ugly day in markets, that's to be clear, but remember there are a lot of people that benefit from this dislocation.
Volatility is good for what parts of your world?
So the trading desks, they really love the elevated flows they saw through last week. They thrive off of that. And remember, there are some hedge funds that are coming back big into the market. 10 to 30% gains in this route.
Come on, but there's just as many others getting hammered, right?
There are, but the thing is, once you see the big names really come back to life, that really helps the trading desk. I want to be clear about something, though. That is through last week. What you woke up to today was gapping volatility, which is when people start to freeze up and delever.
Right, we're about 50 seconds away from getting the market reopened here at 9:49. So, Shonali, I'm looking at the stocks before they halted. They were down. J.P. Morgan down 11%, Goldman down 10% here. So obviously people are concerned about the yield curve and so on. But the reality is, are the banks saying that this is volatility that they like? Because I remember the fourth quarter of 2018, it didn't work out for them.
Exactly. That's the quarter that I always look back to, because the levels now are higher than then, and they lost a lot of money subsequently. So that is a good comparison. But with that said, until last week, you saw a lot of people staying strong, being creative, looking at products their clients are willing to buy in this kind of market. How do you hedge it?
What does banking do? Trading, yes, volatility. Do bankers trade? Is a banker's life based off the VIX?
Well, a trader's life is based off the VIX. But remember, a lot of these, the rally was based on the consumer bank, and the yield curve was expected to steepen at the beginning of the year. Obviously, we're not in that scenario, and interest rates are ever lower. That's horrible for the banks, all of them, and how that impacts the rest of the businesses.
Deutsche Bank under 6 has gone from 10, it's down 40% from the very real recovery as well. Does anybody care? Just one final question, Shonali. Does anybody care about Q4 or Q1 earnings?
Yes, people are going to care about Q1 because nobody's making money, and people are going to have a hard time making money, and even the rainmakers feel like they're mortgaging their success to pay for the consumer.
United goes to their wonderful pilots. United, every other airline's the same, and they go, we're going to put you on half pay, furlough, take vacation days, unpaid, da-da-da-da-da. Great. Do you do that on Wall Street?
You try to work from home. I think the way that Wall Street has changed a little has gotten a little lucky.
Okay.
A lot of things have moved out of the banks, and a lot of things have moved out of the hedge funds.
Shonali Bassick here with her entourage on Global Wall Street.
Exactly. We got the markets open again, Tom. Extending the sell-off. The S&P is down 7.4% right now, 220 points. We were off at 7% on that circuit breaker, now off about 7.36%. Mike Regan covers markets for us for all platforms. He knows what's going on out there. Another person with a lot of experience in the markets. So, Mike Regan, what do you see here this morning? How's it feel to you?
Well, obviously a market-wide circuit breaker being triggered is a spine-tingling event. Haven't seen that. I think there was one during the financial crisis, but certainly something we haven't seen in ever since then. And what was really interesting about it is we hit that 7%. My colleague Andy Cinco noted in the S&P 500, there were still about 170 stocks that hadn't even traded yet when we triggered that first.
You are a font of wisdom. Shonali Bassick didn't know that.
Well, hey, glad I can add some value. But you got to wonder about that second one. The level 2 circuit breaker would be at 13%. Knock on wood, we don't hit that today, but that would be another 15 minutes. 20% drop on the day would just shut everything down for the day. I can't imagine we'll get that today. But
just to close the loop here, we've never done that, right?
Nah. No, not since they've instituted these circuit breakers.
This was after 1987?
Yeah, I can't remember the exact year they instituted them, and they've fine-tuned them. They've changed the levels on them a little bit, but that's what we're looking at now. It's just a surreal experience.
What I would focus on, Paul, is we're pushing 6,000 Dow points down. I mean, I don't have the exact number in front of me.
Well, we're 2,000 Dow points down today, Tom. The Dow's up 7.8% right here. So, Mike Regan, what do you look for here in days like today? Do you think anybody's looking for value? Do you think anybody's just kind of saying, this is really an extraordinary situation. I'm stepping in on the names I have high conviction in?
I'm sure there's a little bit of that going on. I mean, someone's got to be buying for everyone that's selling. But I think for the most part, the consensus is it's kind of a falling knife right now. They want to see some kind of sign that, the bottom could be in. But who knows when that will be. I mean, I think we could be primed for a pretty sharp rebound, not all the way back to where we were, but at least a bounce from these lows. It's very hard, obviously, to time when that will be. Some sign of some good news, I think, could trigger a pretty quick rebound, but it's hard to really predict when that will be.
SPX 2760, and my Chris Nagy analysis is 2600, 2600.
Yep.
Is sort of a level 2 level.
It's interesting. Mike, so what do you make of this U.S. yield curve all sub 1%? What does that tell you?
I mean, it's just, indicative of how much uncertainty and fear there is out there about what to expect, how far this virus is going to spread, and how great the economic damage is going to be at the end of it. So it just really unprecedented moves throughout the market.
I'm going to ask you a question. Maybe you guys have done the research. You have to understand that Mike Regan, folks, has a team of 300 people at his beck and call at any research moment, unlike me and Paul. All we have is Colin of the Twins. But Mike Regan, real simply here, when we go down like that, do we expect companies to come out, and if they love share buybacks at 29,000, are they really going to love share buybacks at 24,000?
Yeah, I think in many ways companies will be like any other investor and try to figure out what is the best time to buy. I imagine they've been buying into this since it started.
Sure.
That was kind of the knee-jerk reaction among buyback desks is on an ugly day buy. So I don't know. You'd have to look at, how much they have allotted and how much they've gone through and whether or not they'll go back to the board and ask for the
permission. Do they have to announce before they do the next tranche of share buybacks, or can they do it before?
I think they have to announce what they're getting approval for what the next tranche is. That said, a lot of companies don't, they announce X billion and they come in a little bit short of that. So I imagine they're all going to try to maximize it. But Tom, you got to worry about the cash flow too if you really should be spending it on stock right now.
Mike Regan, thank you so much. Greatly appreciate it this morning. Down 1790. Paul, I think we sort of got a little bit of a bid going to the market. We were down 2,000 plus at one point.
Yeah, exactly. We're down on the S&P, down 6.6%. Remember that circuit breaker, Tom, the level 1 was tripped at 7%. We're now back kind of a little bit better than that, a little bit of a lift. So we'll see where this trades here over the next several minutes here.
Yeah, and with oil, let me give you the quotes there. 33.13 on West Texas. Brent crude 36.16 as well. Gold flat now, 16.73 an ounce. At one point I saw 1,700 print on gold. DXY cratered about 30 minutes ago. It's come back 95.13 on that blended currency basket. Yen was at 101. A little better tape here, but I want to make clear at 9:55 Wall Street time, we've got a ways to go to find where this market settles. Even Euro Swissy doing stronger Euro, weaker Swissy. Negative 1746.
Asset management.
We've all been in one, but how much do you really know about black cabs? For instance, did you know that a black cab has to be tall enough to accommodate an individual wearing a bowler hat? That's a lot of space for you and your briefcase. Or that Free Now drivers can use the bus lanes, the perfect getaway to make your meeting in time. And with 2-minute central London pickups, you needn't waste time searching for a taxi. Just download the Free Now app today and take the hassle out of getting round London.
Have you heard? The Mayor of London has launched his latest van scrappage scheme to help tackle London's toxic air. Small businesses or sole traders like me with a polluting van could now get £7,000, which you could use to trade up to a Euro 6 vehicle. And you could get an extra £2,500 towards running costs if you go electric. The scheme is now even easier to qualify for, and it's open to any businesses with up to 50 employees, like mine. So, I'm going to search TfL Scrappage to see if I'm eligible and apply. You should do the same. To the Mayor of London and TfL, every journey matters.
At Asda, with our great range of beers and cider, it looks like you're hosting. Get 2 packs for just £18 or just £10 each. Like 12 bottles of Corona or 10 cans of Copperberg Cherry. Cracking brands, refreshing prices. Don't compromise. Asda. Save money. Live better. Selected stores subject to availability. Offer ends 18th of March. 330 millilitres each. Drink aware.
Shh. Whisper it. This LG Turbo Wash with AI Direct Drive will soon be your strong, silent hero. One of the UK's quietest and quickest washing machines, it uses a jet spray to cut your washing time to under an hour. More convenience, less hassle. And with all LG appliances, you can save up to £100 when you trade in your old one. Heroes of the home at Curry's PC World. Full terms at currys.co.uk.
Had the same job for the last 15 years. Working with the same people, in the same office, drinking tea from the same comedy mug, eating the same crayfish and rocket sandwich every lunchtime, using the same business jargon, and climbing the same greasy pole. What does that even mean? Then maybe it's time to switch it up, starting with the all-new Vauxhall Corsa. With its bold styling and up to 70 miles per gallon. To switch it up, visit your local Vauxhall dealership or search New Corsa. Official WLTP test figures for comparison purposes only. Real-world figures may vary.
The moment you realise you've drilled through an electric cable. The moment you realise that doesn't just mean no telly on the wall, but no telly full stop. The moment you realise you've got British Gas Home Care. And not just your electrics, but your plumbing, heating and drains are all covered. So the moment you've got a problem, make it our problem. British Gas, here to solve. Search British Gas Home Care.
Switch to Sky Broadband Superfast. It's so reliable, we'll guarantee your speeds or money back. And for a short time only, it's just £25 a month for 18 months with a $19.95 setup fee. So stay connected with super reliable, super fast broadband at a super low price. Switch or recontract today. Search sky.com. Offer ends 12th of March. Prices may change during this period. Includes Sky Pay As You Talk. Sky Fibre areas only. Speeds vary by location. 1 month subscription refund if speeds drop below minimum download speed for 3 consecutive days. Claim twice in minimum term after first 14 days. See sky.com/guarantee.
Financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney.
Is there any bank right now in the U.S. that you think is a buy?
Do you think Chairman Powell has lost the market?
Jeff Bezos is no dope. What's the big ka-ching?
The big question, I think, for investors is free cash flow.
Breaking market news and insight from Bloomberg experts.
The U.S. tariffs actually hurt both China and the U.S.
Large strategics are looking to either buy or invest in innovation.
Soybeans and corn have been basically at or below the cost of production for about 4 or 5 years.
And what we see more bonds, more yield.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
Good Monday morning from New York City to our worldwide audience. An historic day in financial markets. We have equity trading down about 6%. We have the U.S. yield curve all below 1%. We've got commodities tanking as well. WTI crude down 20%. We're going to bring you all the latest on the market action for the next couple of hours. We're going to focus on all asset classes, starting with those oil markets. But first, let's go to Greg Jarrett of Bloomberg News for a Bloomberg Business Flash. Greg.
Wearing my water wings, Paul. Stocks are down the most since the 2010 flash crash as a full-blown crude price war rattled financial markets already on edge over the spreading coronavirus. Treasury yields have plummeted. Oil's down more than 30%, and the credit markets have buckled. Brian Levitt at Invesco tells Bloomberg he sees a recession in the offing.
This was likely to be a year of stable growth amid supportive policy, and unfortunately this was an exogenous shock that nobody was expecting, and the potential for American consumers to not engage in the service economy for a bit of time here is coming at an inopportune time, and the end of cycle warning indicators are flashing.
We check the markets every 15 minutes throughout the trading day. S&P is down 5.9% down 175. The Dow Jones Industrial Average is down 6.1%, down 1,580. And the NASDAQ is down 5.5%, down 475. The 10-year is currently up 2.4% with a yield of 0.5023%. West Texas Intermediate Crude is down just about 20%, down 8 at 33.29 a barrel. COMEX Gold is up 2% at 1673.50 an ounce. The dollar yen is at 102.27. The euro, $1.1412, and the British pound $1.3097. ExxonMobil is down the most since October 28. ExxonMobil is down 8.1%. That is a Bloomberg Business Flash. Bloomberg Markets is underway with Lisa and Paul.
Thank you so much, Greg Jarrett. And Market Drivers is brought to you by New Jersey Institute of Technology, ranked in the top 2% of universities nationally for mid-career earnings of their graduates. Learn more at njit.edu. As Paul was saying, a historic day, the sell-off, one for the history books, some of the most violent moves, both in stock and bond movements that we have ever seen. Dave Wilson, Bloomberg stocks editor, joining us here in our Interactive Brokers studios. A lot of comparisons being made to 2008, not due to the levels that we're seeing necessarily just yet, but the pace of the move. And can you put into perspective the levels? Where are we going back to when we talk about the sell-off in equities that did hit a circuit breaker off the lows now, has resumed trading? Where are we?
Well, I mean, what you look at as far as the S&P 500 goes is what is it going to take at this point to get to a 20% decline from last month's high? And we've still got another 100 points to go on the index before we get there, if we get there. But here we are talking about all this on the 11th anniversary of the beginning of a bull market. It just goes to show you how things have turned here. I mean, what's happening in the energy stocks is really something to focus on, because you're talking about the biggest drop ever for the S&P 500 energy index. Now, ever in that case only goes back to 1989 when that particular indicator was calculated. I'm sure if you go back to the Black Monday crash in October 1987, you may well see that what's happening in energy stocks today is comparable to what you saw back then.
And just to sort of paint the perspective here, this was triggered by, on Friday, Russia said to OPEC, you know what? We're not going to play ball with you. We're not going to cut production. We're going to say to the shale companies in the United States, you go try to make it work with oil prices plunging, given the fact that demand is falling off a cliff in the wake of the coronavirus. And then Saudi Arabia coming back and saying, you want to play that game? Okay, we'll play that game. Let's ramp up production, sending oil prices tumbling.
And cut prices on top of that, because Saudi Aramco did that over the weekend. By the way, let's not forget Saudi Aramco, now the world's biggest publicly traded company, not so big as a result of what's happening in the oil markets, actually fell below their initial price in today's trading. But what's interesting is you've actually seen some of the biggest oil companies come off their lows. ExxonMobil down about 10%, but you had a double-digit percentage decline in that stock in early trading. Chevron's off its low a bit. I mean, with the smaller companies, you're really seeing the stocks get hit. I mean, you just take a look at what's happening with the energy index in terms of the worst performers. I mean, you've got stocks down 40, 50%. Smaller companies for the most part, which raises an obvious question. With oil prices being down as much as they are, what happens to these smaller companies? Do they just have to close up shop? Do they have to, restructure? What do they do?
Maybe some consolidation. Maybe some of the bigger companies come in. I've heard that rationale a little bit.
Well, I'll tell you, Occidental Petroleum, which was doing some consolidating of its own last year. Let's not forget Warren Buffett's Berkshire Hathaway backing him up on a deal. Occidental's down 46%.
I'm looking at, just switching gears to the banks here, looking at the kind of where we have with the interest rates. JP Morgan down 10%, Citi down 10% today. So just the banks just getting crushed, 52-week lows. The charts look terrible there. If you look at the 200 moving day average, really ugly in the banks.
Yeah, I mean, and let's face it, with yields coming down the way they have, you can see where the biggest U.S. banks are getting closer to being in the same position that their European and Asian peers have been in for the last couple of years, as interest rates have gone negative. Bond yields have gone negative.
This is a whammy on many sides for the banks, right? Because you've got yields that are falling to zero. You also have the idea that capital markets are going to slow down and probably already have halted for the most part for the near term. We've seen credit sales freeze up, IPOs not come to market. Meanwhile, what we have from Dick Bovey from Odeon Capital, the bank analyst, he came out and said a sharp decline in oil prices will be a body blow to an industry already at high risk. He advised that investors avoid the group as all major banks, like Bank of America, JP Morgan, Citi, and Wells Fargo are large lenders to the energy sector. This was an issue that we saw before. And then smaller banks also exposed. You just have a lot of different factors here weighing in.
Yeah, you do, and all kind of pointing in one direction, which is down. And that explains why these stocks are taking such a beating. I mean, you have to look pretty hard to find groups outside of energy that are doing worse. One, though, is definitely the cruise line owners. I mean, given that the State Department's telling Americans, don't go on cruises. Right. So, you got Carnival, Royal Caribbean, Norwegian, all down more than 12%.
Given how fast the market is moving, we should give you a sense that actually U.S. equities well off the earlier lows of 7% that triggered the circuit breaker. We're now seeing the S&P down 5.7%, NASDAQ 5.3%, and the Dow 5.8%. So we are seeing some of the worst losses of the day paired when there was a concern that perhaps this was just going to be free fall. Oil, however, not so lucky. still very much in free fall. And we should mention bond yields absolutely cratering with the expectation for the Federal Reserve to basically cut rates to zero within the next few meetings, Paul.
Yeah, and Cameron Price from Bloomberg News was on earlier, and he says, you look at some of the futures for interest rates, it's as if the market is discounting today that those rates will stay low for a very long period of time as well.
This has been one characteristic of the market, that even as we see the expected Fed funds rate to go to 0.1% as soon as June, okay, so that's basically zero. That's between 0 and 0.25%. We're seeing the yield curves flatten. So this basically, the implication is the Fed's going to cut rates and it's not going to do anything to ignite longer-term inflation.
Bloomberg Stocks editor Dave Wilson, thank you so much for joining us. We'll be talking to you later today. We know you're going to be busy tracking what's going on in the markets for us here at Bloomberg Radio. S&P right here down 5.4%. As Lisa was mentioning, it was down as low as about 7.3, 7.4%. It tripping that level one level about earlier this morning at a 7% decline, bouncing back just a little bit here. And again, looking at crude, WTI crude down 19%. That is $33.52 a barrel, had been as low as 27 cents a barrel. Right now, let's head down to our 99.1 studios in Washington, D.C. for World and National Headlines with Nathan Hager. Nathan, what do you have?
Well, Paul, I'll give you some of the latest on the coronavirus as far as its spread throughout the world. The number of confirmed cases in Spain nearly doubled overnight from 589 to 999. Italy has shut down all its schools and imposed travel restrictions in its north. French President Emmanuel Macron is calling for an urgent coordinated response in Europe. Dr. Anthony Fauci is part of the U.S. response as head of infectious diseases at the National Institutes of Health.
There's no doubt you shouldn't say no travel for anyone. We certainly are not there yet. But what you got to be careful about what category you fall in.
Now, elderly people with underlying medical conditions, he says, should think twice about getting on a plane, and the State Department is asking all Americans to avoid cruise ships. The Democratic presidential race is heading into Mini Tuesday.
Tuesday is a very, very important day, and Michigan is the most important state coming up on Tuesday.
Bernie Sanders rallied more than 10,000 of his supporters last night at the University of Michigan in Ann Arbor. Joe Biden also is hoping for a strong showing in Michigan. He's got more endorsements from former rivals. Cory Booker and Kamala Harris both plan to join Biden at a rally in Detroit tonight. Afghanistan had dueling presidential inaugurations today. Former President Ashraf Ghani took the oath of office after he was declared the winner of his country's contested election from September. At the same time, former chief executive Abdullah Abdullah held a parallel ceremony in Kabul. He declared himself the winner. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nathan Hager. This is Bloomberg.
Revisions, return policies. There are so many ways to redo a decision.
What are the ramifications if she crumbles or doesn't crumble?
Do they have any path other than the courts?
Except here, we have to get it right the first time.
We always talk about the losers in a trade war. Are there winners?
So that you can too.
How does your modeling have to pivot to reflect a different scenario?
Bloomberg Radio, the Bloomberg Business, Radio.com, and iHeartRadio apps, and BloombergRadio.com. Bloomberg, the world is listening.
Hi, it's Olivia Munn with my shelter pets, Frankie and Chance. Say hi, guys. When I adopted them, I discovered that they both have incredible personalities. Chance's sole purpose in life is to love and to be loved. Frankie is a little bit of a scoundrel and always entertaining. They're a little bit of a lot of things, but they're all pure love. Adopt pure love at theshelterpetproject.org. Brought to you by the Ad Council, the Humane Society of the United States, and Maddie's Fund.
Are you interested in a challenging and exciting career? One where you can be part of solving complex challenges across industries and geographies. Bloomberg's ever-expanding technology, data, news, and media services foster innovation, empower clients, and offer nearly limitless opportunities for career growth. Visit Bloomberg.com/careers today to view our current job opportunities. Bloomberg LP is an equal opportunity employer. The address once again is Bloomberg.com/careers.
If you love them enough to listen to them practice the same song on tuba,
Please be done.
over and over and over and over and over, then surely you'll check NHTSA.gov/the right seat to make sure they're correctly buckled in the back seat.
Sounds good, honey.
Check today at NHTSA.gov/the right seat. Brought to you by the National Highway Traffic Safety Administration and the Ad Council.
In-depth.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
On average, in London, a scooter or motorbike is stolen every hour. Make sure it's not yours. Lock your bike, chain the rear wheel, and cover to make it harder to steal. Lock, chain, cover. The Met Police.
Delayed at the dentist and now you're late for school pickup. You need a free now. Need to take the dog to the vet before lunch. Should have gotten a free now. Trying to get 4 kids and their baggage to the airport. Free now. Sometimes you can't get from A to B fast enough. Download the Free Now app today for quick pickups and reliable drivers, no matter the situation. Less hassle, more hustle with Free Now.
Welcome to Costa, the nation's favourite coffee shop. What can I get you?
A flat white, please.
And would you like to enter the 10 million point Costa Coffee Club giveaway?
Yeah.
And collect points towards free coffees and treats in store.
Thank you.
You're welcome.
Registered Coffee Club members only. 18 plus, GB only. Excludes Northern Ireland. Purchase required. 9th of March to 5th of April. The question, what is your favourite branded coffee shop, was asked. See costa.co.uk for full details and T's and C's.
Vodafone 5G will have the power to change your world. From driverless cars to virtual reality and real-time gaming. That's why we're rolling out 5G in London and across the UK. Discover Vodafone 5G on the UK's best mobile data network. The future's exciting. Ready? Vodafone.
NPerf testing awarded Vodafone Best 2019 Mobile Internet Performance based on 35,664 tests on the NPerf app in the UK. Coverage may vary. Visit vodafone.co.uk.
This ad is made from 100% recycled commercials. Just like Smart Water's
all new
bottles are made from
100% recycled
plastic.
What's that number again?
100%. Every Smart Water bottle is made using recycled plastic, and because it's still
100%
recyclable, the plastic will be used again
and again.
Smart Water, now in a 100% recycled plastic bottle. Label and cap 100% recyclable, but not made from recycled plastic. Yet. We're working on it.
Matt Letizia, what did you make of that performance today?
Well, it really was a game of two halves, to be honest, Jeff. Leicester came out in the first half really...
Letiz?
What's up, Jeff?
Run for it!
What's the...
Move over, football. Cheltenham coming through. And Sky Bet are on the charge. With money back as actual cash, up to £10 if you lose on the first race of the festival. Sky Bet. That's betting better. Applies to first bet on first race at Cheltenham on losing singles and win part of each way singles only. Money back as cash, free bet stakes excluded, eligibility restrictions, T's and C's apply. 18 plus, begambleaware.org.
How do you channel your inner calm? Meditation? Yoga? Or within the sanctuary of your Citroën C3 with 11 driving aids and wide, comfortable seats? Calm really does come from within. Citroën C3, now £199 per month with an initial rental of £199 and £500 of lease price.
Citroën.
Citroën UK Limited, a credit broker, not a lender. Personally, you will not own the vehicle. Offer on field PureTech 83 manual. 6,000 miles per annum. Guarantee may be required. Terms, eligibility criteria and return conditions apply. PSA Finance UK Limited. Participating dealer stock vehicles ordered between 1st and 22nd and registered by March 31st.
Petrol or electric? Why choose petrol and electric? Discover the BMW plug-in hybrid and electric range. 14th to the 21st of March. Visit your BMW retailer. Sometimes electric, always BMW. Participating retailers only.